Martin, who's a superstar wine critic with enormous experience in Bordeaux and Burgundy, and the former lead critic at The Advocate, wants to come and be part of our team, that says something.
You make it sound like The Wine Advocate was a disaster as a company and a miserable experience as an employee.
No, it was great, because I got to work with Bob Parker when he was at his prime, you know, and Bob was like a second father to me, and we talked on the phone all the time, and he gave me great advice.
Can anyone's palate dominate the wine criticism business the way Parker's did? And should anyone's palate dominate it the way his did?
I just think the world is very different today. You know, I mean, it's just a totally different world. It's probably not healthy to have a single person dominating the world.
It's not even wine criticism, it's the wine industry.
Yeah, that's probably not the healthiest thing in the world. But I think that there's just such an opportunity right now with social media and technology to reach such a massive number of people that I think it's possible that one or two people will actually have more influence than Bob Parker did, because they will, again, this goes back to your first question, not trying to be a version of somebody else. You see this in sports all the time. It's like, oh, well, nobody will ever beat this record. And then somebody comes along, you know, it was like tennis, Pete Sampras. Nobody's ever going to win as many Grand Slams. Now you have two guys who are ahead of that and one knocking on the door. And so I think a lot like that.
You're a former investment banker. How does that inform and influence what you're doing and what you've done?
My generation has had to deal with a lot more challenges. That's why I think we're actually much better poised for the future. My first job in finance, the first thing that happened was long-term capital, 1998. Then the tech bubble melted down. Then there was a mutual fund trading scandal. You know, that was all like within about 5 or 6 years. And these are the things that I had to deal with as a young executive. My peers who were 20 years older didn't know how to manage in crisis. They'd only seen Black Monday. They'd just been in a big bull market. It's very different. So I'm very lucky. People of my generation or a little bit younger have actually had to deal with a lot more crises. I think that's actually good for learning how to cope with challenges in business.
From the outside, it kind of looks like you're trying to demolish the house that Parker built, right? You left the Wine Advocate.
Yeah.
You merged with one of his chief rivals.
Yeah.
And you just hired his successor, Neil Martin.
Mm-hmm.
So are you?
I think what that says is that all the best people want to work at our company, and that's really what we strive to create starting in 2013. We wanted to create a world-class company that would attract the best-in-class talent, and not just on the content side, on the technology side, on the digital side, our office, and at every level, what we're trying to, we only hire superstars, and we're looking for those superstars.
the world of professional wrestling, there's something called a swerve.
Hulk Hogan has betrayed WCW!
Some examples. These tag team partners are called babyfaces, or the good guys. Then one of them swerves when he super kicks his tag team partner in the head, quickly assuming the role of the bad guy, or what the wrestling world calls the heel.
Are you kidding? What a despicable act that was!
Or a match is almost lost when, what's that? The superstar wrestler appears out of nowhere sprinting down the aisle to save the match.
That's the Warriors music! It's the Ultimate Warrior!
That's a swerve. So it should go as no surprise that World Wrestling Entertainment, known as the WWE, the most popular brand of sports entertainment in the world, is prepared for any swerves that come their way. So here's the story of how the WWE learned to see the swerve coming. So I spoke to Bloomberg reporters Felix Gillette
I'm a writer for Bloomberg News for the global business team.
and Kim Basine
And I'm the U.S. luxury reporter at Bloomberg.
to find out exactly how the WWE is positioning itself for an all-out global invasion, which starts with a massive change to their lucrative pay-per-view model.
WWE basically pioneered the pay-per-view model on cable. I remember as a kid, when the pay-per-view events came up, all of our friends would scramble around and try and get one of the parents to pay for it.
But in 2014, they took a huge risk.
They saw a little bit sooner than some of the other entertainment brands that where this whole thing was moving was away from cable and satellite television and towards on-demand streaming video apps. They made this risky decision, in essence, cannibalizing that pay-per-view model, which they had essentially built.
And after some early turbulence, it's working. Roughly 1.5 million people are paying $9.99 a month for the WWE app, making it the 5th most popular streaming OTT service. This adapt-or-die approach is in the WWE's DNA. Over the past 30 years, the company always seems to think 2 steps ahead. In the early 90s,
WWE was at its most threatened when Ted Turner took them on with WCW.
which stands for World Championship Wrestling. And back then, the WCW was winning the ratings war. So in order to compete with them,
WWE had changed its product from a family-friendly kind of cartoonish style to this really raw. That's why they called their show Raw. It was this raw style of wrestling.
with violent, outrageous, reality-inspired plot lines and aggressive personas.
From a 16-foot ladder!
And they won that fight against Ted Turner. And they bought WCW.
The early 2000s ushered in an era of testosterone-driven programming aimed at the red-blooded American male.
Bra and panties matches, and people smash each other over their head with like barbed wire bats and things like that.
Until 2015, when WWE fans started a hashtag Give Divas a Chance. Since then, WWE has hired 40 more female wrestlers, and that growing cast of female characters was part of a much larger plan.
They started to try to appeal to a broader set of people.
Let's attract more female fans. And after we've attracted more female fans, let's attract more international fans. They're broadening their base, and they're doing that in large part to make it more advertising friendly.
And not just friendly to advertisers.
They're trying to build up their fan base in China. They're trying to build up their fan base in Europe. They, already have a pretty good fan base in India.
India is a place where they already have an established wrestling culture.
Because of the gigantic Indian wrestler, the Great Khali. But there's still a lot of work to do. While the WWE set a revenue record in 2017, only 30% of it is coming from an overseas audience. And there's one person whose responsibility is to grow that number.
The buck eventually stops at Vince McMahon, no matter what's happening within WWE.
Yeah, he's a very controlling guy, and it's a very, very, very tightly scripted company.
And that goes all the way down the board to big stars' entrance music and their outfits and things like that.
So with a CEO like McMahon always planning 2 moves ahead and an aggressive push into multiple international markets, a big issue is money.
It's hard to do all those things simultaneously without committing a huge amount of capital to it.
And that's where the WWE becomes an attractive company for buyers.
Potentially, one thing that could happen with WWE is they could benefit by being acquired by a bigger technology or telecom company, an Amazon or Facebook Paramount or a 21st Century Fox.
So with a market cap of $2.8 billion, the advantage of owning 100% of their own content, and a rapid consolidation spreading throughout the entertainment industry, it looks like the WWE is well positioned, even if there are swerves.
Our world is changing. Every day, it changes a little faster. Some changes are too small to see. Others, too big to handle. Sometimes, change feels slow. So slow, we don't even notice. Other times, it happens all at once, and we can't keep up. For our climate, change means many things. And between too small to see and too big to handle, there is a whole world of difference. The clock is ticking. This is Bloomberg Green.
Saving the seas. This week, the deep-sea diver who stopped writing the ocean's obituary to find a solution. Enric Sala tells us why the next 10 years matter most. And globalization needs to get greener. Shipping accounts for nearly an eighth of all transport emissions. How can the industry clean up its act? Plus, protecting coastlines comes at a huge environmental cost. But one Israeli startup found a way to keep the sea out and the animals in. From London, I'm Anne-Marie Hordern, and this is Bloomberg Green. After more than a decade of studying the ocean as an academic, Enric Sala realized he was writing the ocean's obituary. He quit his job and became a full-time conservationist. As an in-house explorer for National Geographic, he's clocked more than 5,000 open water dives. He's also founded Pristine Seas, a project that combines exploration, research, and media to lobby countries to protect their oceans. To date, it has helped create marine reserves equivalent to half the size of Canada. I spoke to him about his mission and why it's so urgent.
The state of the world's oceans is really bad. We have lost 90% of the large fish in the ocean. Sharks, groupers, cod, tuna. More than half of the fish stocks are overfished, which means that we are taking them out of the water faster than they can reproduce. More than half of the ocean is affected by industrial fishing, and global warming is killing coral reefs all around the world. The ocean is in a trajectory of decline.
Can you just visualize for our viewers who never get to see the kind of things you are able to see, what an ocean and healthy ecosystem looks like versus one that's next to a bustling economic and industrialized area?
Coral reefs in the United States, in the Florida Keys, are down to only 2% of what they used to be. Before, 80 to 90% of the bottom on a coral reef in the Caribbean was covered by live coral. Now, Florida Keys have only 2%. The average in the Caribbean is about 5% of the bottom covered by live coral. The rest is covered by slime and seaweed. And most of the fish you can see are this big. And it is very, very rare that if you jump into any place in the Caribbean at random, you see a shark. It's very, very rare. Now, let's go to Millennium Atoll, for example. An atoll that is uninhabited and fished south of the equator in the Central Pacific, belongs to the Republic of Kiribati. 2009, we conducted the first underwater expedition to this island, and I still remember the first time. Jumped over the side of the boat, and as soon as the bubbles cleared, I was surrounded by 15 gray reef sharks. After a couple minutes, the sharks decided that we were boring, and they went back to do their thing. And you look down, 90% of the seafloor is covered by thriving coral, and it's full of fish, and a sea turtle comes by. Now, this abundance that we rarely see anywhere except in well-managed marine reserves. This is what the ocean used to be like, and this is what we have learned from going to these pristine places.
And you write in your book that you're writing the obituary of ocean life. What's the cure?
The cure is doing less harm. Basically, there are three things that we are doing to the ocean. One is we are taking fish out of the water faster than they can reproduce. Two, we are turning the ocean warmer and more acidic because of man-made climate change. And three, we are throwing in everything that we don't want, our waste and our plastic. We need basically to reverse these trends.
Does this mean that a lot of this falls to governments and their policies?
That's a big part of it, because it is governments that regulate fishing and mineral extraction and oil extraction. It is governments that have the legal authority to create large marine reserves in the ocean. But also, local communities have an important role to play because some of the most successful protected areas in the ocean are community-led and community-managed marine reserves. So when the fish come back, the divers come in. And that creates huge economic opportunities through ecotourism. These areas that are managed by communities are very successful because the communities have a vested interest in having as many fish as possible inside them so they can enjoy the benefits.
What from the pandemic has changed your view when it comes to protection of the environment?
Nature has given us a very strong signal of how fast it can recover if we just give it space. Everybody was fascinated by all these videos of the whales and the dolphins coming into marinas and mountain lions on the streets of Santiago in Chile, wild goats in the UK. Nature has this extraordinary ability to bounce back if we just give it space. This is why we need to protect at least 30% of the planet by 2030.
How do healthy marine ecosystems help in the fight against climate change, though?
Most people see the ocean as a victim of climate change, but the ocean can also be a solution because we know that the more life there is in the ocean, like big fish and big whales, the more these organisms help to make the ocean productive and absorb more CO2. The kelp forest, seagrass beds, all of these are important ecosystems in the ocean that are similar to the forest on the land that capture a lot of our carbon pollutions.
What are you most excited about in your field?
We have 10 years to fix this problem. Global fisheries catch is going down, stocks are collapsing. Business as usual means that by 2050, 90% of the coral reefs are gone, that most commercial fisheries have collapsed. That affects food security, that affects migration of people. We have 10 years to get to peak greenhouse gas emissions and then go carbon neutral by 2050. And we have 10 years to protect at least 30% of the ocean so we can restore much of this health and productivity, not just for saving biodiversity, but also saving our life support system. We are not talking about something that is apart from us. We are not apart from nature. We are a part of nature. So these 10 years are probably the most critical in the history of humanity.
The most accurate measurements of changing oceans will come from space. While Enric Sala explores what lies beneath, a new satellite is giving us data from above.
We'll learn more about our oceans and climate change, but from space. A new satellite's been launched from California. Its mission, track the accelerating rise of sea levels.
Well, the main instruments on board include a dual-frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise.
Data gathered from Sentinel-6 will be used alongside information from other satellites to build as complete a picture of the oceans as possible.
With a long record, we can precisely measure the acceleration. We eventually can detect new regime, tipping points. For example, if there is a runaway in the melting of Greenland or Antarctica, sea level will record this runaway change because it is an integrator of all changes that are occurring in the climate system. So we will be able to see some change, big change in the global climate.
The National Oceanic and Atmospheric Administration expects that sea level rise will increasingly threaten U.S. coastlines. One example, the southern tip of Manhattan is expected to flood 20 to 40 times a year by 2030.
11 of the 15 largest megacities are located at the coast, and this number will double. The number of people living in coastal area will double by 2060. So, knowing how much sea level is rising at the coast and how much it will rise in the future in coastal areas is as obvious. It's obviously a major goal for human beings.
Coming up, from sails to steam to oil, the shipping industry is no stranger to change. But how will it navigate the next transition? This is Bloomberg Green. From Bloomberg's European headquarters in London, I'm Anne-Marie Hordern. This is Bloomberg Green. Now, for your roundup of this week's latest climate news, Jennifer Zabazaja has your Green in Brief.
Here's the climate news you need to know. Deforestation of the world's largest rainforest has hit a 12-year high. More than 4,000 square miles of the Amazon rainforest was destroyed in 2020. That's a 9.5% increase from a year earlier. Government data shows that destruction has soared since President Jair Bolsonaro took office and weakened environmental enforcement. The Amazon is home to millions of species and plants and is critical in the fight against climate change. Bitcoin is hitting all-time highs, but at what cost to the environment? The cryptocurrency is energy intensive, and there are concerns if it becomes mainstream. According to MIT, back in 2018, Bitcoin's carbon footprint was almost as big as Portugal's. Want to get better at tackling climate change? We'll hire more women. That's according to Bloomberg New Energy Finance. Firms with 30% or more women in top jobs tend to perform better when it comes to the environment and are more likely to set clear climate goals. Shopping online is more popular than ever now, but the price of convenience is measured in CO2, and more deliveries means more fuel burned and more packaging wasted. So what can companies do? Well, many are becoming more efficient and sourcing more clean energy for their data centers and warehouses. And England's farmers will be paid to go green after Brexit. As European subsidies are phased out, they'll get new money to encourage them to produce healthy, sustainable food. Poor farming practices are one of the leading drivers of water pollution and the loss of biodiversity. I'm Jennifer Zabazaja in New York. Anne-Marie, back to you.
The shipping industry is more than just the grease on the wheels of globalization. It's its chief enabler. 11 billion tons of goods are transported by ship each year, the biggest contributors being 2 billion tons of oil, 1 billion tons of iron ore, and 350 million tons of grain. According to the International Chamber of Shipping, 80% of Europe's imports and exports happen over the seas. And for such a vast industry, it also contributes its fair share of emissions. Shipping makes up 12% of global transport energy consumption. So how does it clean up its act? Earlier, I caught up with Bloomberg Green reporter Laura Milan about just how big of a challenge this is going to be for the industry.
One of the main issues is size. So about 90% of the world's cargo is moved by ships. So obviously changing such a huge industry is not going to be fast and it's not going to be easy. The second issue has to do with technology. So ships obviously travel for many days at sea. It's not as easy for them to refuel as it would be for a car, for example, going on a road. And the sector still hasn't found a technology that's economically viable and that's zero emissions and equivalent to the electric batteries for cars, for example.
But actions are being put in place to make the industry a bit more environmentally friendly. Walk us through those steps that they're taking.
That's it. So there's a first step that would involve using low emission fuels or biofuels that would significantly reduce the existing emissions. And then at a regulatory level, when it comes to the policy and the governments, there are steps being made as well. I would say that the most significant ones come from the European Union, which started to track emissions a few years ago and is now looking to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
The concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube sized concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, E-concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing e-concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
But e-concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism die, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics.
The units require less maintenance and could therefore stay in the water for longer. E-concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, e-concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate. I'm Anne-Marie Hordern, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week. The Fed Decides with Carol Messer and Bloomberg Quick Takes Tim Stenovec on Bloomberg Radio.
Yes, indeed, everyone. This is a Fed Wednesday, April 28th, 2021. It is the third policy meeting of the Federal Reserve here in 2021, and the Fed keeping rates unchanged as expected, maintaining its $120 billion monthly bond buying. Tim, this is widely what we expected. This was expected to be a bit of a snoozer when it comes to a Fed meeting.
And that's exactly what the equity markets are doing. Pretty much flat for the S&P 500, not changing significantly, just a tiny leg up when that news came out.
And inflation, listen, this is something that we've talked about so much on air. The Fed saying inflation has risen, largely reflecting transitory factors.
There's that word, Carol.
Exactly. And we had a conversation yesterday. What's transitory? Is it a couple of weeks? Is it a couple of months? Is it a year? What is it?
The Fed also saying that financial conditions remain accommodative.
And economic activity and employment have strengthened. We are seeing a little bit of a tick higher here along the yield curve. That 10-year note with a yield of 1.65, that 5-year note yielding 0.89, and the 2-year note, the shorter end of the yield curve, pretty much staying as it was prior to the Fed news, 0.17. But we're going to dig a little bit deeper into that. And as you said, the equity markets, they have been pretty mellow today, really looking at those earnings to come. They're pretty much where they were prior to the Fed news, Tim.
Yeah, not much movement there in the equity markets. The S&P 500 down just about well, really flat right now.
Kind of getting exactly what we expected from the Fed. Even so, we're going to parse over every word in the statement and Fed Chief Jay Powell's press conference coming your way in 29 minutes' time. First up, though, let's get to Charlie Pellet with a check on that trading day. Charlie, not too much of a reaction.
Indeed. Right now, we are looking at a half-point drop in the S&P 500 index. Worth repeating the headlines. The Fed decides. Fed keeping rates unchanged, maintaining that $120 billion monthly bond buying. 10-year yield now 1.64%, did tick up to 1.65%. The Dow down 138 points, down 0.4%. NASDAQ lower now by 16. That is a drop of 0.1%. 10-year worth repeating 1.64%. Gold down 0.1, 17.74 the ounce. And West Texas Intermediate crude up 1.6%, 63.97 a barrel. So again, recapping now, the S&P turning around, pushing higher, up now by 4 points. I'm Charlie Pellet. That is the Bloomberg Business Flash.
All right, Charlie, thank you so much. Focus on the Fed on this Fed Wednesday, brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. All right, let's set the market drivers report. And let's do it. Let's set the Business Week agenda with Kathleen Hayes, Global Economics and Policy Editor at Bloomberg News, here in our Bloomberg NYC Bureau. Dave Wilson, Stocks Editor at Bloomberg News, on the remote access from New Jersey. Kathleen, this is your day. Tell us what we need to know about that Fed decision.
Well, as you said, this is pretty much as expected because the Federal Reserve, especially in its policy statement, look at 1, 2, 3, 4, 5 paragraphs, terse, closely watched, and very carefully worded. They're not going to give us any nuances, well, maybe we are thinking about, when we have to start tapering. Nothing like that. We have to wait for Jay Powell, the Fed chair's testimony, his grilling by reporters, which starts now less than a half an hour from now. I quickly popped up one of the coolest things we have on the Bloomberg terminal. As soon as we get those headlines out, we also have the statement comparison. And right at the top, compare March 17th meeting to April 28th. They changed this wording about how they're looking at the economy before they preceded their statement of seeing, somewhat better growth, et cetera. They started with following a moderation in the pace of recovery. Economic indicators have turned up recently, although, inflation is still not near target. But today, it starts with, I think this is important, amid progress on vaccinations and strong policy support. This is what everybody's saying. We saw that strong consumer confidence report yesterday. A lot of people saying, hey, Fed, you're going to face an economic boom driven by, first of all, the vaccines, but maybe even first of all, the fiscal stimulus, right? And reopenings. So this is what Jay Powell's going to get grilled about. The market didn't move much. I, like you, Carol, was keeping my eye on the bond markets before. I think the 30-year got a little bit weaker. Yeah. So maybe they were hoping for something they didn't get or fearing something. But for now, we just have to wait to hear from Jay Powell.
And looking at that statement a little bit further, Kathleen, the sectors most adversely affected by the pandemic remain weak but have shown improvement. So again, a little bit insight, Tim, into what the Fed had to say.
Hey, Dave Wilson, come on in here and give us the equity markets reaction, because there was a little bit of a flip, right? The tiny dip reverse that we saw, right, when those when those headlines came out, that reversed very quickly.
Yeah, bounce down, a bounce up, and
I love when the S&P is down 1 and then it's up 2, right? That's a flip.
It was like,
Sorry,
the
Dave.
tiniest of possible flips.
Sorry,
it doesn't get much smaller
exactly.
than that.
We're sort of on the same wavelength, Carol. Not much of a move at all. Though we did see the S&P 500 get to the low of the day before it bounced up and then pulled back. You're talking about a relatively narrow range for the index post-statement, no question. So you're left with a market that's really focusing on earnings because Fed's policy is steady as she goes. They're going to keep up their bond buying and all the rest. So, you're kind of left with, what you get out of first quarter results to drive the market. And the short answer is not much, because you've got pretty big moves in either direction, kind of canceling each other out to some extent. So, that's really the story of the day as much as anything.
So what is any sort of surprise in here, Kathleen, that you've seen as you had a few minutes to dive into the statement a little? Is anything sticking out, or is everything as expected?
Sure. Well, I could say a surprise is that they're not a little more optimistic, given some of the numbers we've seen. We had such a strong jobs report last month.
Where's their like taking off the mask conditionally?
But you know what? It's interesting because this is something that's very important to the Fed, and I would be willing to wager. And I know when I asked Jim Bullard about this, President of St. Louis Fed, what was that, about a week and a half ago now, about how do you see the end of the pandemic? He was talking about 75 to 80% of the people vaccinated, for example. But I'll bet you that for the Fed, this is going to be when you can take off the mask, Carol, and the CDC. People don't read the news enough or listen to Bloomberg enough because a couple days ago they said if you're outside, hey, guess what? You don't have to wear a mask if you're vaccinated, and they probably in their heart of hearts are saying that maybe you didn't need to wear a mask, you don't need to wear one at all. But that's the kind of thing that's going to encourage people to really get out. The reopenings that have started to get even stronger, that's what the Fed is waiting to see. But we're at the beginning, we haven't seen it yet. But again, to your question, I think the fact that they start with progress on vaccinations, strong policy report. And remember, this is the same day that Joe Biden hits us with his plan. It's going to cost a lot of money, but it could make even more of a boost. This is what the Fed's going to have to, at some point, probably not in the too distant future, start grappling with.
Well, is this a situation, Kathleen, and of course we're going to hear from Fed Chair Jay Powell in just about 22 minutes from now. We'll take everybody live to Fed headquarters when he begins holding that press conference. But is it a case of, what the Fed says versus what the Fed does, right? They did nothing. They did change nothing, essentially, in just a few words in that release. But, I mean, they're going to get a lot of questions. So what holds more weight, actions by the Fed right now or what their tone and what they might say in that press conference later on?
I think for the markets and many people watching the Fed, it's the tone. Does Jay Powell start giving us more of a sense that, okay, the more we get this virus behind us, and with all this tremendous amount of spending, I mean, think about it. The Fed started this new framework, right? We have to see inflation above 2% and staying there. We have to see full employment. Back in a period of years when they could not get inflation to move higher, they couldn't even get it to 2%, let alone staying there. But hey, Fed, look where we are now. The largest peacetime stimulus for the United States in modern history. Look at all the people in the market saying, there's going to be more inflation and it may not prove to be transitory. So I think this is the kind of thing that we need to hear more from Jay Powell, because they're not going to raise rates for a while. That's fine. But we need to know, when are you going to start buying so many bonds? That was an emergency move, you guys, right? Just like keeping the key rate at 0. Are we really in an emergency now, right? When do you start whittling that back? I think, Carol, that's a great question. And again, if Jay Powell may just keep saying, nope, not ready, not ready, not ready, but that's what everybody's waiting to hear.
Hey, Dave, do equity investors and do companies buy the fact that the Fed continues to say inflation is due to, quote, transitory factors, higher prices, we've heard, and input costs from Kimberly-Clark, Procter & Gamble. Mondelez, I'll say it, Spotify prices are going
expensive.
Up. They are.
Well, I mean, let's face it, food and energy prices, you kind of take them out of the core calculation of inflation. But when you're talking about food companies, what they pay for the raw materials is certainly a big piece of their cost. So to that extent, it's out there. And it's not just the food industry. We've seen other companies talk about how they've seen prices going up, whether it comes to raw materials or transportation. So it's an issue out there. Whether it's one that the Fed is ready to tackle is a whole nother story.
Exactly. All right, guys, thank you so much. Great breakdown. Kathleen Hayes, Global Economics and Policy Editor at Bloomberg News. Catch her on Daybreak Asia a little bit later on Bloomberg TV. And Dave Wilson, our stocks editor at Bloomberg News. Be sure to check out the one Dave for his stock of the day. Let's do the Bloomberg Business Week Fight of the Day.
Let's do it. It's one number that tells us a lot. Brought to you by GEP. GEP helps businesses transform supply chains with strategy, managed services, and AI-based cloud-native software. Learn more at GEP.com.
And Tim, today's number, 100 million.
Nexon said it bought $100 million worth of Bitcoin, joining a list of tech companies embracing the digital currency. The online game provider acquired 1,717 Bitcoins at the average price of about $58,226 each. That includes fees and expenses. Now, this purchase represents less than 2% of Nexon's total cash and cash equivalents on hand, but is the largest ever purchase of digital currency made by a company traded in Tokyo.
It's just about putting like an asset on your balance sheet that you hope is going to go up. Is that what that is? Like, I'm thinking about Tesla, I'm thinking about others.
And MicroStrategy.
Yeah.
Right?
Well, that's their business strategy,
Yeah.
right? But I mean,
Tesla
other
more
companies,
so, right?
yeah, or this is a company that, I don't know, they're doing other things, but they're putting Bitcoin on their balance sheet.
That's the question. I mean, it fluctuates so much that it's, do you want something that changes in value so quickly? And it's traded on weekends. That's a point that Mike Regan made in one of his columns. Do you want something that trades on weekends on your balance sheet?
You're just hoping it's going to go to 100,000 pretty quickly. All right, let's get a check on world and national news over to Nancy Lyons. She's in D.C. Hey, Nance.
Hey, Carol. Well, President Biden will be appearing before a joint session of Congress tonight to give a speech addressing everything from universal pre-K to gun safety laws. Bloomberg's Amy Morris has a preview.
The American Families Plan focuses on human infrastructure, childcare, healthcare, and education by increasing capital gains taxes, corporate income taxes, and funding the IRS to help them crack down on tax scofflaws. President Biden also plans to call on lawmakers to pass stricter gun safety laws with a focus on 2 House-passed bills that have not gotten enough support in the Senate. Our coverage of the president's speech tonight begins at 8:30 Wall Street time on Bloomberg Radio. In Washington, I'm Amy Morris, Bloomberg Radio.
There are multiple reports that federal investigators have carried out a raid on Rudy Giuliani's apartment and office. It's believed to be part of an investigation into whether the former New York City mayor, who became President Trump's personal attorney, has violated lobbying laws in his dealings with Ukraine. A juror who is part of the Derek Chauvin trial in Minneapolis is speaking about the deliberations. Brandon Mitchell tells ABC's Good Morning America jurors came to a consensus pretty quickly on whether Chauvin caused the death of George Floyd by holding his knee on his neck.
For the most part, it was straightforward. There were a few hiccups with, terminology and understanding exactly what the instructions were for each case. But like I said, for the most part, we got in, we got out.
Chauvin was found guilty on 2 counts of murder and 1 count of manslaughter. He'll be sentenced in the next few weeks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Now let's check in with Charlie Pellet for a business flash.
Thank you very much, Laura. Little changed on this Fed Wednesday. We have got the Dow Jones Industrial Average down by 0.4%, slumping 139 points. S&P swinging between gains and losses, now up by 0.5 point. Emphasis on little change. We've got NASDAQ down 14, a drop of 0.1%. Treasuries holding modest losses after the Fed kept rates pinned near zero and maintained the pace of bond purchases as was widely expected. Our coverage will continue right here on Bloomberg Radio. The Fed did strengthen its view of the economy and said recent increases in inflation look, quote, transitory, reassuring investors that the central bank is in no hurry to tap the brakes on growth. 10-year yield 1.64%. Gold down $3 the ounce, lower by 0.2%, $17.73 the ounce. West Texas Intermediate crude up 1.5% right now, $63.85 a barrel. 16 minutes away from Fed Chair Jay Powell. You can hear him live and watch him on Bloomberg Television and Radio. Recapping equities mixed. S&P up now by 0.5 point. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Carol Massar, Tim Stanovic in our Interactive Brokers studio. Fed officials strengthening their assessment of the economy today, signaling that risks have diminished while leaving their policy interest rate near zero and maintaining a $120 billion monthly pace of asset purchases. Man, it's exactly what everybody was forecasting. So let's get to it. Let's talk about this decision.
Ira Jersey's chief U.S. interest rate strategist at Bloomberg Intelligence joins us on the phone from New Jersey. And Lindsay Piegza, chief economist at Stifel, joins us on the phone from Chicago. Thank you so much to both of you for joining us. Ira, I want to start with you, your reaction when this came out just 15 minutes ago.
Yeah, pretty much what we were expecting. The modest mark-to-market of the economic outlook, I think, was largely anticipated. And, the one thing that was maybe a ever so slight surprise was a little bit of a downgrade to the risks to the economy statement that appear in the third paragraph. So, it's very incremental. I think more important is going to be what Jay Powell says, and if he lets slip anything about maybe when they're going to start thinking about reducing asset purchases.
So what you're referring to is the path of the economy will depend significantly on the course of the virus, including progress on vaccinations. The ongoing public health crisis continues to weigh on the economy, and risks to the economic outlook remain.
That's not Tim. That's the Fed statement.
Yeah, Right, that's the Fed speaking. That's the third paragraph in the release.
That's the new Fed statement. But it used to say that that opposes considerable risk, right? So now it just is a risk as opposed to a considerable risk. And I think that's an ever so slight, modest upgrade, I think, to their outlook. And but more importantly, I think is going to be, eventually they're going to start to reduce their asset purchases. And what we're going to be listening for during the statement is any hint as to when they're going to think about that. There were some big trades put on in some rates products for August, maybe at Jackson Hole, for it to be kind of hinted that they're going to be thinking about reducing their asset purchases. So, there's a lot of moving parts here, but that has to be the first act that's going to be, less dovish by the Fed, and that's probably going to come next year, but they're going to start talking about it at some point probably this year.
Right, and that Jackson Hole meeting, right, that's going to be over the summer typically, right? So we'll see whether or not that we get anything out of that. Hey, Lindsay, come on in. Thanks for your patience. What's your take on the Fed decision?
Well, again, the policy decision very much in line with expectations in terms of asset purchases and rates. I did like that the Fed acknowledged the recent improvements in the domestic economy. I think that helps the committee maintain their credibility, that they're not completely ignoring the steps that we have taken in the right direction. But they weighted that appropriately with the sense that the recovery is still far from complete and continued support is still warranted. So really acknowledging, again, what's happening in the marketplace juxtaposed with their continued initiatives to keep the economy on track. But to the earlier point, I do think it's very clear that the chairman has no intention of raising rates or removing asset purchases anytime in the near future. They've been clear that they want to offer adequate timing, adequate preparation time for the market to adjust to any sort of taper, and no discussion was seen in the statement at this point. So not only are they not adjusting policy, they're not even outlining a timeline for that adjustment at this point.
Ira, I got to ask you, somebody tweeting out, I sure as hell don't want to be the guy or known as the guy that crashed the party with a picture of Jay Powell. How much of what Jay Powell is doing, I mean, listen, it feels like he's a very thoughtful, steady Fed chair and looking at kind of all of the economy that's going on, but we have heard from him time and time again that he's willing to let maybe inflation run a little hot. Like the fear is they don't want to do anything that slows any of the comeback economic momentum.
Yeah, I think that's exactly right. But the point that this Federal Reserve has learned, like they've taken all the lessons from the past, and particularly from after the global financial crisis, and that is that it's easier to deal with inflation than deflation. We know how to deal with runaway inflation, right? We know that we can slow the economy down. We know that we can raise interest rates to 20% like Paul Volcker did back in the 1980s, right? We know that there's a path to do that. But the trick is that nowhere in the world, when you have demographics as poor as they are, with debt burdens where they are as well, for you to generate inflation in a way that Milton Friedman would be happy with in terms of monetary stimulus, right? So we know that monetary stimulus doesn't work the way that we thought it did prior to the 1980s. So now we have to deal with, will we get back on track? Will we reach these levels that the market is currently pricing in terms of inflation? We're pricing 2.5% inflation over the next 5 years. How do we get there? And, what that looks like is going to be very important to the Fed. And they keep on talking about, and they said it again in this statement, that any inflation is likely to be transitory. So they're not really worried about near-term little spikes in inflation. They want to see inflation go up, and they want to see that being driven by wages and for employment to be the driver of inflation going forward, because that really is what helps the consumer sector and the economy in general.
Well, Lindsay, what to that point and to that end, what does transitory actually mean? How many quarters do we need to hear from companies saying that their inputs are costing more and that they are planning on raising prices for inflation not necessarily to be transitory?
Well, from a consumer standpoint, transitory is going to be a very short period of time because we're going to start to feel that in a matter of months. But from a monetary policy standpoint, the framework that the Fed is now using is a longer-term approach to inflation. So they're willing to be patient against the backdrop of rising rates for potentially several quarters. In fact, just to put this in perspective, the average rate of inflation has been averaging 1.3% since 2015. 2015. So potentially, the Fed could allow inflation to run at 3% for the next 5 years and still not exceed their longer-term average of 2%. So the Fed really has the luxury now under this new framework to be very patient and allow inflation to temporarily run hot, much longer than consumers or producers would like. But again, from a monetary policy standpoint, there's not going to be any pressure on the Fed to act anytime soon.
Two things I want to bring to your attention. One of our listeners and followers on YouTube tweeting out, if their assessment is so positive, why are they buying assets at a $1.4 trillion annual rate? At the same time, the two of you, Ira and Lindsay, Julia Coronado, also familiar to our Bloomberg audience, says the removal of considerable to characterize risks in the FOMC policy statement confirms an evolution has begun, although they cite the role policy is playing in supporting the recovery twice in the first paragraph, underscoring patience and the gradual nature of this evolution. I mean, Lindsay, it makes me wonder, right, if the Fed hadn't been doing what they have been doing over the past 13 months and counting, safe to say we'd be in a different spot.
Well, I don't think it's just the Fed. I think it's the federal government, too.
Correct.
And I think the Federal Reserve is acknowledging the fact that, look, we're going to see stellar growth in the first quarter when we get that GDP report. And it's likely going to be a pretty solid growth profile for much of 2021. But what happens when we start to remove that punch bowl? So the Fed is acknowledging the fact that we've taken steps in the right direction, but much of that growth is very artificial in nature, reliant on these unprecedented policy supports. So the Fed is saying we're not ready to remove that support until we know that the recovery is organic in nature, and we're going to start seeing that organic improvement in consumption and business investment independent of these direct payments or enhanced benefits from the federal government.
You are listening to Bloomberg Business Week. Carol Massar, along with Tim Stenovic in our Interactive Broker studio, our conversation around that latest Fed decision, third of the year, this 2021 year. And the Fed strengthening their assessment of the economy, signaling that risks have diminished while leaving their policy interest rate near zero, maintaining that $120 billion monthly pace of asset purchases, which is what everyone was predicting. We're still here with Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence, on the phone in New Jersey. Lindsay Piegza also with us, Chief Economist at Stifel Financial, on the phone from Chicago. So, Ira, what's next? What are the data points that you focus on to kind of get an idea of the trajectory of where we go from here, and to kind of keep a watch on, whether or not inflation truly is just transitory?
Well, I think it's all the standards. So it is the employment report, it's retail sales, things like that, because that is such a huge part of the economy. I look at a lot of the internals of CPI, and one of the things that we have to realize is that over the past decade, over the decade in between the great financial crisis and the onset of the COVID pandemic crisis, we had basically goods prices continued to actually decline modestly almost every single year. Meanwhile, you had wages that continued to be higher. So when you look at things like core services prices, which tend to be driven by wage growth, those were pretty good prior to the pandemic. Goods prices, on the other hand, kept on slipping, and there was plenty of supply. There weren't any issues in the supply chain like you've had over the past couple of quarters. Now that's flipped. So now what we're seeing is goods prices going up. So when Carol, when you mention that companies are saying that they have to raise prices because their inputs are up, those aren't service companies. Those are goods companies. Right. That's only 20% of the economy. The other 60% of the economy, that's core services, is driven by wages, and wages still are not climbing particularly fast, and there's still large portions of the economy where wages are actually falling because there's not jobs anymore. There's, a lot of service sector businesses have closed because of the pandemic, and it'll take a long time for them to reopen. So I think when we talk about, headline inflation, we could see that be high because of food prices, but core inflation is still not likely to be much higher than 2% over the next year, at least based on our forecast.
Good point.
Yeah, Lindsay, same question to you. Data points that you're looking at that you think could potentially change the way that the Fed is thinking about things.
Well, we're a consumer-based economy, so I do think first and foremost we need to focus on the health of the consumer. But unfortunately, we're not going to get clean data on the consumer for several months. We're still going to see the impact of that March stimulus package, those direct checks flooding into the economy. So we're going to have to be patient for a couple of months before we can really see that underlying momentum of how the consumer is faring out in the marketplace. Also, inflation. This is going to be some key data points for the Fed to justify their policy response bonds against the backdrop of the message that they're sending that these price increases are going to be temporary, going to be transitory. On the heels of what was just said, I do think it's important to note that inflation numbers are likely to get worse before they get better. Even if we just see a minimal 0.1 of a percentage point growth on a monthly basis in the next 60 days, the headline is likely to push well over 4%. So there's still more pressure to come. But again, the Fed is going to focus on the fact that this is more of a reflation trade, or some of those lower lows of 2020 falling out, as opposed to sustained inflation.
Well, and I want to mention, too, when we got Visa earnings last night, and the Visa CEO has been on various airwaves saying that they see the beginning of the end of pandemic spending woes. So their debit card volume soared after those stimulus payments. So we definitely did see that direct impact. We heard that from Chipotle's CEO talking about the stimulus impacts in addition to their new quesadilla, which is really amazing. But nonetheless, stimulus payments having an impact. So Ira, when we talk about inflation, and I just heard, heard Lindsay talk.
Okay, traders, it's time to play stop on profit for euro, and I'm looking to sell euro at 121.01. Okay, as you remember, as you can see, we still hold position on euro at 120.99. So I place stop on profit at 121.01. It gives us 2 pips in profit. We've been holding this position for a few days, so it became not profitable to keep this position. So right now it's better to close this position and move on. Okay, so let me point out where we purchased this pair, just right here, and this is stop on profit for this pair, 121.01. Okay, let's see if it will move on. We will keep moving. If not, no, it's look like we will get filled with this order, with this position. Yep, position closed on euro. All of you guys who follow this trade, you closed as well this position that you can see from our ticker at 120.99 we purchased. We closed this position, so we don't have any positions right now on euro. Okay, this is just accidentally line appeared. Okay, let's move on. We made £200 in profit on this position. You guys made profit. It all depends how much you decided to invest in your contract, or maybe you was trading Forex note as a CFD or E-mini or whatever. These days, so many different derivative instruments. You can trade options, anything. So you can see the profit. You already know how much profit you made. Okay, well done. Let's move on, and I'll speak to you later.
Powell press conference, where he will make a brief statement and then answer questions from the members of the press community, of course, virtually. The big headline: the Fed strengthening their assessment of the U.S. economy today, signaling that risks have diminished while leaving their key interest rate, Tim, near zero and maintaining that $120 billion monthly pace of asset purchases. We expected this.
We did. The Fed also saying recent inflation pickup is due to, quote, transitory factors. No big surprise there that the Fed said that. And $120 billion in monthly bond buying pace remains unchanged. I'll tell you what, Carol, a question that I expect him to be asked is about the housing market and how hot it is, the U.S. housing market. Right. And how difficult it is for consumers to enter the housing market right now. He's been asked about that in the past, and I expect that he'll be asked about it again.
Right. The supply-demand equation there is totally thrown off. All right, we do this with the Dow right now, down 115 points. The S&P just up about 2 points. The NASDAQ down about 11. And we really haven't seen much of the yield curve change as well. Let's take you to the Federal Reserve. Jay Powell, of course, the chairman of the Federal Reserve, getting ready to make his statement. Let's listen in.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, my colleagues on the FOMC and I kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Since the beginning of the year, indicators of economic activity and employment have strengthened. Household spending on goods has risen robustly. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also increased. Spending on services has also picked up, including at restaurants and bars. More generally, the sectors of the economy most adversely affected by the pandemic remain weak, but have shown improvement. While the recovery has progressed more quickly than generally expected, it remains uneven and far from complete. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. Since March, progress on vaccinations has limited the number of new cases, hospitalizations, and deaths. While the level of new cases remains concerning, especially as it reflects the spread of more infectious strains of the virus, continued vaccinations should allow for a return to more normal economic conditions later this year.
Okay, ready? Here we go.
In the meantime, continued observance of public health and safety guidance will help us reach that goal as soon as possible.
3, 2, 1. We recap President Biden's first 100 days. We'll do that with a Washington insider and examine the challenges the president faces going forward.
Plus, it's a mega earnings day, including results from Twitter and Amazon.
Sector posted a notable gain for the second
Let's do it one more time.
Yeah.
We'll break them down or something.
Nonetheless,
Okay, here we go. 3, 2, 1.
in this sector is still more than 3 million below its level at the onset of the pandemic.
3, 2, 1.
For the economy
President
as a whole,
Biden 100
payroll
days
employment
in.
is
We'll take a look at
8.4
that with a
million
Washington
below its
insider
pre-pandemic
and the challenges the president faces
The
going
unemployment
forward.
rate
Plus, it's a mega
elevated
earnings
at
day.
6%
After the bell, we're going to get results
and
from
this
Twitter
figure
and
understates
Amazon.
the
We'll bring them to you
shortfall in
live.
Employment, particularly as participation in the labor market remains notably below pre-pandemic levels. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. Readings on inflation have increased and are likely to rise somewhat further before moderating. In the near term, 12-month measures of PCE inflation are expected to move above 2%, as the very low readings from early in the pandemic fall out of the calculation, and past increases in oil prices pass through to consumer energy prices. Beyond these effects, we are also likely to see upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transitory effects on inflation. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As we say in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. I would note that a transitory rise in inflation above 2% this year would not meet this standard. In addition, We will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our goals, and it is likely to take some time for substantial further progress to be achieved. Our guidance for interest rates and asset purchases ties the path of the federal funds rate and the size of the balance sheet to our employment and inflation goals. This outcome-based guidance will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I'll look forward to your questions.
Thank you, Mr. Chair. First, we'll go to Paul Kiernan.
Hi, Chairman Powell. Thanks for doing this. I guess since I'm first, I'll go ahead and re-up Howard's question from the last press conference. Is it time to start talking about tapering yet? Have you and your colleagues had any conversations to those effect? Thanks.
Thank you. So, no, it is not time yet. We've said that we would let the public know when it is time to have that conversation, and we said we'd do that well in advance of any actual decision to taper our asset purchases, and we will do so. In the meantime, we'll be monitoring progress toward our goals. We first articulated this substantial further progress test at our December meeting. Economic activity and hiring have just recently picked up after slowing over the winter, and it will take some time before we see substantial further progress.
Thank you.
Thank you. Janelle at Reuters.
Okay, hi, thank you so much. My question is about what's going on with the virus and what if we don't reach a level of herd immunity per se? So in your scenarios, thinking about the outlook in the economy, do you have a model where you might start to still normalize policy, even if there's like a baseline of infections still going on? Or how can you talk about how you're weighing those things?
Yeah. We have to leave questions about herd immunity and what that looks like to the health experts. But I would certainly say that what matters the most to the economic recovery continues to be controlling the virus. The economy can't fully recover until people are confident that it's safe to resume activities involving crowds of people. There may be people who are around the edges of the labor force who won't come back in unless they feel really comfortable going back to their old jobs, for example. And there may be parts of the economy that just won't be able to really fully re-engage until the pandemic is decisively behind us. But we've articulated particular guidance for tapering our asset purchases and for lifting off and raising interest rates. So for asset purchases, we've said that we would continue at the current pace of asset purchases until we see substantial further progress toward our goals. So, and that is what it is, substantial further progress. For interest rates, as I said a moment ago, we want to see labor market conditions consistent with maximum employment. We want to see inflation at 2%, and we want to see it on track to exceed 2%. So those are our tests. We don't have an independent test to do with the virus. I will say, though, as I started with, the path of the virus is going to have an effect on our ability to achieve both of those tests.
Great. Thank you. Gina.
Hi, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about that test for raising interest rates that you just elaborated. You've obviously made it very clear that you want to see improvements in the real economy, in the real data, and not in just sort of expectations data before making that move. But I guess I wonder what happens if inflation expectations were to move up before you see some sort of return to full employment. It seems like a lot of sort of the stability in inflation has been tied to the fact that those have been so low and stable. And I guess I wonder how your reaction would be, or sort of how your reaction to that is how you're thinking about that.
Right. So it seems unlikely, frankly, that we would see inflation moving up in a persistent way that would actually move inflation expectations up while there was still significant slack in the labor market. I won't say that it's impossible, but it seems unlikely. It's much more likely that we would, having achieved maximum employment conditions, we'd also be seeing 2% inflation and be on track to see inflation moving above 2%. They tend to move together. So that's not to say inflation might not move up, but for inflation to move up in a persistent way that really starts to move inflation expectations up, that would take some time, and you would think that it would be quite likely that we'd be in very strong labor markets for that to be happening. If that actually were to happen, though, there's a paragraph in the statement on longer run goals and monetary policy strategy, which says that when the two goals are somewhat in conflict, we weigh various factors, including the time it would take to get back and forth. So it doesn't really tell you what to do, but it tells you that we will weigh those two factors and how far we are away from them and how long it would take to reach them, were we to reach that sort of pretty unlikely state.
Thank you. Steve Laceman.
Thank you. Mr. Chairman, I want to follow up on Janelle's question, and I wonder if you can help us understand better your thinking about how COVID infection rates and the virus calibrate with monetary policy. As you recall, we had a major resurgence in the virus last fall, and I'm wondering, would you need to be assured that there wasn't such a resurgence coming before you began, I mean, for lack of a better term, thinking about tapering? And what kind of comfort level would you need? Would it be something that would be declared from the CDC or the World Health Organization, for example, downgrading the virus from a pandemic before you had the comfort level to reverse course on policy? Thank you.
Yeah, we really have just articulated the goals that I've just mentioned a couple of times, which is substantial further progress toward our goals before we taper. Now, that's very likely for us to achieve that. It's very likely going to be the case that we've also made really significant progress on controlling the virus through vaccination and other, those two things should more or less coexist. We haven't articulated a separate test for a state of the virus that we'd like to achieve, because we're not experts in that area. We're really focused on the economic outcomes. And again, my guess is that it's very likely, it seems to me, that for us to achieve the economic outcomes we would need to taper or to raise interest rates, we would also have to have made very substantial progress in getting the virus under control. Not necessarily fully under control. There is a possibility, of course, that we will have ongoing outbreaks over the summer, various regional outbreaks, and potentially next winter as well. But we'll be looking for substantial progress toward our goals, substantial further progress toward our goals as we think about tapering asset purchases.
Thank you.
Thank you. Victoria.
Hi, Chair Powell. I wanted to ask, you've talked a lot during this crisis about the need to have a lot of help from fiscal policy and monetary policy to make sure that there's not long-term scarring in the economy. And I was just wondering, given all of the policies that have been put in place, do you expect there to still be some long-term scarring? And if so, what are you most worried about? Where are you most worried about that showing up?
So I would say that we were very worried about scarring, both in the labor market, from people being out of the labor market for an extended period of time. The evidence is clear that it becomes much more difficult if you're out for a long time to get back in and get back to the life that you had. Same thing with these small businesses, many of which are the work of generations. Were we going to wipe out many of those unnecessarily? That was a big concern. I would say that so far, here we are in late April of 2021, we haven't experienced that level of scarring either in the labor market or among smaller businesses. So we're not living that downside case that we're very concerned about a year ago. Notwithstanding that, we're a long way from full employment. Payroll jobs are 8.4 million below where they were in February of 2020. We've got a long ways to go. And also, it's going to be a different economy. So we've been hearing a lot from companies that they've been looking at deploying better technology and perhaps fewer people, including in some of the service industries that have been employing a lot of people. it may well be, it seems quite likely that a number of the people who had those service sector jobs will struggle to find the same job and may need time to find work and get back to the working life they had. These were people who were working in February of 2020. They clearly want to work. So those people are going to need help. And so while I would say we haven't seen really highly elevated levels of unemployment for, up in the teens that we thought we might have for an extended period of time, we've still got a lot of people who are out of work. We want to get them back to work as quickly as possible, and that's really one of the things we're trying to achieve with our policy.
Thank you. Rachel Siegel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. The housing market in many American cities is seeing booming prices, bidding wars, and all cash offers well above asking price. And this is happening at the same time that housing is becoming much more expensive for lower income Americans and people who are still struggling from the pandemic. Do you have concerns that there are localized housing bubbles or that there's the potential for that? And what is the Fed doing to monitor or address this? Thank you.
So we do monitor the housing market very carefully, of course. And I would say that before the pandemic, it's a very different housing market than it was before the global financial crisis. And one of the main differences was that households were in very good shape financially compared to where they were. In addition, most people who got mortgages were people with pretty high credit scores. There wasn't the subprime, low doc, no doc lending practices were not there. So we don't have that kind of thing where we have a housing bubble where people are over levered and owning a lot of houses. There's no question, though, that housing prices are going up, and so we're watching that carefully. It's partly because there's clearly strong demand, and there's just not a lot of supply right now. So builders are struggling to keep up with the demand. Clearly, inventories are tremendously low. We're all hearing those stories. And if you're an entry-level housing buyer, this is a problem because it just is going to be that much harder for people to get that first house, and that's a problem. I mean, it's part of a strong economy with people having money to spend and wanting to invest in housing. So in that sense, it's good. It's clearly the strongest housing market that we've seen since the global financial crisis. And, my hope would be that over time, housing builders can react to this demand and come up with more supply, and workers will come back to work in that industry. So, it's not an unalloyed good to have prices going up this much, and we're watching it very carefully. I don't see the kind of financial stability concerns, though, that really do reside around the housing sector. So many of the financial crack-ups in all countries, all Western countries that have happened in the last 30 years have been around housing. We really don't see that here. We don't see bad loans and unsustainable prices and that kind of thing.
Thank you. Chris Rugaber, Associated Press.
Hi, thank you for taking my question. I wanted to ask about the labor market. Do you see things such as in the Beige Book, you saw in the Beige Book anecdotes about businesses not able to find workers, back to the labor market for fear of getting sick, childcare concerns, and so forth? Do you see these as also just sort of temporary bottlenecks that won't have much effect on the long-term health of the labor market? Or how are you thinking about these kinds of issues?
Chris, you were breaking up a little there, but I think I did get your question. So, yeah, I think there are a number of things going on there. The tension between a high level of unemployment and yet many companies saying they can't find, an elevated number of companies saying that they can't find workers. So what's really going on there? It should be a number of different things. There are workers who don't actually have the specific skills that the employers are looking for. There may be geographical differences. It may also be that, for example, one big factor would be schools aren't open yet, so there's still people who are at home taking care of their children and would like to be back in the workforce but can't be yet. There are people afraid of there are virus fears that are weighing on people, so some people don't want to go back to work. There are also a significant number of people who say they've retired, a large number of people that say that they're retired. Now, it's hard to say whether they will come back in as the labor market strengthens and as COVID becomes in the rearview mirror in the history books, if you will. So, but clearly there's something going on out there as many companies are reporting labor shortages. We don't see wages moving up yet, and presumably we would see that in a real, in a really tight labor market, and we may well start to see that. I do think, so what will happen, what we saw during the last expansion, and it may be a different expansion, we don't know, but what we saw was that labor supply generally showed up. In other words, if you were worried about running out of workers, it seemed like we never did. The labor force participation held up. People came in the labor force. They stayed in the labor force longer than expected. So my guess would be that you will see people coming back into the labor force, and these jobs will be, the labor market will reach equilibrium. Maybe pay will go up. But I do think that, and I do think also the unemployment insurance benefits will run out in September. So to the extent that's a factor, which is not clear, it will no longer be a factor fairly soon. So my guess is that we'll come back to this economy where we have, equilibrium between labor supply and labor demand. It may take some months, though.
Thank you. Heather Scott.
Quick follow, or?
I'm sorry, go ahead. Go ahead, Chris.
Well,
we lost you, Chris. Let's go on to Heather.
Thank you. Good afternoon, Chair Powell. I wanted to ask, you've been hearing, of course, these concerns raised by Larry Summers and others about inflation and the fact that they think the Fed might let things get out of hand with the new policy stance. So my question is, can you tell us what is different this time versus previous periods like in the 60s when inflation got out of control? Why are you confident with the lags in monetary policy that the Fed can get ahead of inflation and make sure it doesn't go too far above the 2% target?
Your question. So I actually have a couple of things I'd like to say about inflation, including addressing your question. So let me start with just saying that we're very strongly committed to achieving our objectives of maximum employment and price stability. Our price stability goal is 2% inflation over the longer run, and we believe that having inflation average 2% over time will help anchor long-term inflation expectations at 2%. With inflation having run persistently below 2% for some time, the committee seeks inflation moderately above inflation above 2% for some time. So with a little bit of context, we're making our way through an unprecedented series of events, really, in which a synchronized global shutdown is now giving way to widespread reopening of economies many places around the world. In the United States, fiscal and monetary policy continue to provide strong support. Vaccinations are now widespread, and the economy is beginning to move ahead with real momentum. During this time of reopening, we are likely to see some upward pressure on prices, and I'll discuss why. But those pressures are likely to be temporary as they are associated with the reopening process. And an episode of one-time price increases as the economy reopens is not the same thing as, and is not likely to lead to, persistently higher year-over-year inflation into the future, inflation at levels that are not consistent with our goal of 2% inflation over time. Indeed, it is the Fed's job to make sure that that does not happen. If, contrary to expectations, inflation were to move persistently and materially above 2% in a manner that threatened to move in longer-term inflation expectations materially above 2%, we would use our tools to bring inflation and expectations down to mandate-consistent levels. And I would say, if I may, that is a principal difference from, we're all very familiar at the Fed with the history of the 1960s and 70s, of course. And we know that our job is to achieve 2% inflation over time. We're committed to that, and we will use our tools to do that. So that's a very different situation than you had back in the 1960s. There are many, many differences, actually. Let me talk quickly about the two reasons, two or you could say three, but really two main reasons why we think inflation will move up in the near term. The first is the base effects. 12-month measures of inflation are likely to move well above 2% over the next few months as the very low inflation readings recorded in March and April of last year drop out of the calculation. That process has already started to show up. You saw it in the March CPI reading, and you'll see it later this week in the PCE price data. These base effects will contribute about 1 percentage point to headline inflation and about 0.7 of a percentage point to core inflation in April and May. So significant increases, and they'll disappear over the following months. And they'll be transitory. They carry no implication for the rate of inflation in later periods. So that's base effects. The other big one I would talk about is bottlenecks. So this is what we're seeing in supply chains in various industries, and we're in close touch with all of these industries. You know, the Fed has a network of contacts that is unequaled in businesses and in nonprofits for that matter too. So what do we mean by a bottleneck? A bottleneck really is a temporary blockage or restriction in the supply chain for a particular good or goods, something that slows down the process of producing goods and delivering them to the market. We think of bottlenecks as things that in their nature will be resolved as workers and businesses adapt, and we think of them as not calling for a change in monetary policy since they're temporary and expected to resolve themselves. We know that the base effects will disappear in a few months. It's much harder to predict with confidence the amount of time it will take to resolve the bottlenecks, or for that matter, the temporary effects that they will have on prices in the meantime. So, you know, I'll just sum up and say we understand our job, we will do our job, and we are focused, as you've seen, for many years, we've been focused on inflation deviating below 2%, and we used our tools aggressively to keep it back up at 2%. If we see inflation moving materially above 2% in a persistent way that risks inflation expectations drifting up, then we will use our tools to guide inflation and expectations back down to 2%. No one should doubt that we will do that. This is not what we expect, but no one should doubt that in the event we would be prepared to use our tools.
All right, you've been listening to Fed Chairman Jay Powell, the live press conference after that Fed decision where they upgraded the view of the economy but kept rates near zero and continued those asset purchases. Let's go back to Jay Powell and that press conference at the Fed headquarters.
You said a few weeks ago that it would take a string of months of job creation of about 1 million to achieve progress towards your goal. Can you define what your definition of a string of months is more specifically? And on inflation, the FOMC said the rise in inflation we're beginning to see largely reflects transitory factors, as you just described. But why use the word largely? And what are the factors driving higher prices that may not be transitory based on the initial data that you're seeing?
So what is a string? What do I mean by a string? Well, I would say what we have right now is one really good I can tell you what it's not. It's not one really good employment reading, which is what we got in March. We got close to 1 million jobs in March and a very strong labor market reading. And I was just suggesting that we'd want to see more like that. We're 8.5 million jobs below where we were in February of 2020, and that doesn't account for growth in the labor force and growth in the economy, the trend we were on. So we're a long way from our goals. And we don't have to get all the way to our goals to taper asset purchases. We just need to make substantial further progress. It's going to take some time. On largely, you know, there are a bunch of factors. I was really thinking, we were thinking of the base effects and also the energy effects. I wasn't meaning to say there are some real effects. I mean, there are always relative prices going up and down within inflation. You know, there's a basket for CPI or PCE. There are, you know, many factors that go into it. Relative prices are always moving up and down. We think it's very fair to say that the increases we see and frankly are about to see later this week are largely due to base effects. It would have been more contentious to say entirely due to base effects because there are some things that are always going up, and so we just said largely.
Hi, Chair Powell. Thanks for taking our questions. Over the past decade, the Fed has invested significant resources in large-scale bank supervision. It has completely overhauled that approach, and it's even created a special committee that looks horizontally across the largest banks to find common risks. did the Fed not see that multiple banks had large exposures to Archegos? If not, why not? And then what regulatory changes would you like to see implemented to change that going forward?
Yeah, we supervise banks to make sure that they have risk management systems in place so that they can spot these things. We don't manage their companies for them or try to manage individual risks. In the grand scheme of these large institutions, the Archegos risks were not systemically important or were not of the size that they would have really created trouble for any of those institutions. What was troubling, though, was that this could happen in a business for a number of firms that is thought to carry relatively well understood risks. The prime brokerage business is a well understood business, and so it was surprising that a number of them would have had this, and it was essentially, I believe, the fact that they had the same big risk position on with a number of firms, and they weren't some of the firms were not aware that there were other firms that had those things. I wouldn't say it's in any way an indictment of our supervision of these firms. In some cases, it seems as though there were risk management breakdowns at some of the firms, not all of them, and that's what we're looking into.
Thank you. Nancy Marshall-Genzer.
Hi, Chair Powell. I'm wondering, are you planning to visit the homeless encampment that's in Washington? Have you been invited? And if you went, what would you be looking to learn there?
You know, frankly, yes, I have not had a chance to do it yet, but I've been very busy. But I will visit. I don't want to visit at a time of a lot of media attention because I don't want that to be part of the story. But I will go visit when it's no longer a news story. And I've met with homeless people many times, a number of times anyway, let's say. And I think it's always good to talk to people and hear what's going on in their lives. What you find out is they're you. They're just us. I mean, these are people who, in many cases, had jobs and they have lives and they've just found themselves in this place. It's a difficult problem, though. There are many facets of it, and I'm well aware that this is not something that the Fed has all the tools for or anything like that. But I will do that when the need arises and when it's not so much, in the public eye.
And is there anything specifically that you would be looking to learn there?
Not really. I mean, I think I know what I'll find there. I think you connect with these people, and what you find is they're like you. Yeah, that could be you. I mean, that could be your sister. That could be your kid. You always feel that way in that sort of an encounter, and it just is. It's an important thing to engage in, I think, and I think we bring that understanding into our lives and, frankly, into our work, the work that we do as well.
Thank you. Hannah Lynn.
Hi, I wanted to ask about digital currency. You've previously said a few times that you think it's important for the U.S. to get a central bank digital currency right rather than be first. But with countries like China moving very quickly on CBDC, I was wondering what you think the risks are of moving too slow on digital currency.
Right. So I think the first thing to say is that we feel an obligation to understand the technology and all of the policy issues very, very well. Central bank digital currencies are now possible, and we're going to see some of them around the world. And we need to understand whether that's something that would be a good thing for the people that we serve. How would it work in our system? And there's some very, very difficult questions to answer, but I think we are engaged in a serious program to understand both the technology and the policy issues. I would say this: we're the world's reserve currency, and that means that the dollar is used in transactions all around the world, far more than any other currency, and that's because of our rule of law, our democratic institutions, which are the best in the world, our economy, our industrious people, all the things that make the United States. That's why we're the reserve currency. And of course, we have open capital accounts, which is essential if you're going to be the reserve currency. So those are the factors that make us the reserve currency. I'm less concerned that another country might have a digital currency. First, ask yourself the question, does that mean that if you were a company that's doing international business, would you then suddenly start to use that currency to do your international transactions, or would you still do them in dollars, which is what everyone does? And I'm not so concerned about that. I am really concerned about getting it right. It is a tricky set of questions that we have to navigate in a world where we already have, remember, a highly evolved payment system. We have FedNow and other immediately available funds. Pretty soon, everybody will be able to do what people do in other parts of the world, which is just use their phone to make immediately available payments all the time. It'll be normal. And what would be the role of a central bank digital currency in that kind of an environment? Far more important to get it right than it is to do it fast or feel that we need to rush to reach conclusions because other countries are moving ahead. I mean, the currency that's being used in China is not one that would work here. It's one that really allows the government to see every payment that's used for which it is used in real time. It's much more to do with things that are happening within their own financial system than it is, I think, to do with the global, sort of global competition.
Thank you. Michael Derby.
Thank you for taking my question. I wanted to ask you another question about inflation, and it has to do with inflation expectations. A number of different surveys and market indicators are showing, multi-year highs in inflation expectations readings. So I wondered, if that was something that you saw as consistent with your inflation outlook. Is that something that worries you, or do you see that as maybe, the success of the Fed's new inflation framework, making it out to the broader public?
Right. Inflation expectations before the pandemic hit, and here we think of survey, market-based, survey being either households or economists and market-based. You look at all of those, and I would say that they were at the low end of what would have been consistent with a 2% inflation target, particularly our 2% inflation target, which calls for 2% average inflation. So they were at the low end. Inflation expectations actually went down a bit at the beginning of the pandemic, and now they've just moved back up to levels broadly that are where they were in 2018 or in some cases 2014, and I would say more consistent with our mandate. And we want them to be. We want them to be higher and on a persistent basis. We want inflation to run a little bit higher than it has been running for the last quarter of a century. We want it to average 2%, not 1.7%. And for that, we need to see inflation expectations that are consistent with that, really well anchored at 2%. We don't really see that yet, but I would say that break-evens have moved up in a way. Break-evens are based on CPI, of course, but they're now at levels that are pretty close to mandate consistent, whereas before they were below. We monitor inflation expectations very, very carefully, as you would obviously know. So that's where I would say it is.
One small follow-up. Do you have any red lines on inflation readings where if you hit like a certain number on, say, core PC, that would be a trigger response from the Fed?
It doesn't work that way. Inflation measures are always going to be a bit volatile. We expect, as I mentioned, core and headline PCE to move up because of base effects, and and we expect that to go away. We also expect these bottleneck effects to come in. We don't know how persistent they'll be. We think they'll, it's a matter of when they will pass through, not whether they will pass through, but we can't be confident about the exact timing of that or the size of them. They don't seem especially large at the moment, but we don't know. I mean, this is all about the reopening of the economy. That's what's happening. We were in a deep hole a year ago, and now with a lot of help from fiscal policy, some additional help from monetary policy, and a great deal of help from vaccination, we're seeing a strong rebound in activity. And what's happening is demand can be spurred with fiscal transfers and the saved up fiscal transfers and people going back to work and things like that. The supply side will take a little bit of time to adapt. New restaurants will have to be opened. The supply of various inputs into the goods part of the economy will have to be brought back up to speed. And you're seeing some of that. That'll happen over a period of time. Over coming quarters, you'll see some of the bottlenecks resolved, but the last one may not be resolved for some time.
Thank you. Brian Chung.
Brian Chung with Yahoo. Hi, Chairman Powell. Brian Chung with Yahoo Finance. I wanted to ask about financial stability, which is a part of the Fed's reaction function here. It seems like to people on the outside who might not follow finance daily, they're paying attention to things like GameStop, now Dogecoin. And it seems like there's interesting reach for yield in this market, to some extent also Archegos. So does the Fed see a relationship between low rates and easy policy to those things? And is there a financial stability concern from the Fed's perspective at this time?
Right. So we look at financial stability for us is really, we have a broad framework. So we don't just jump from one thing to another. I know many people just look at asset prices and they look at some of the things that are going on in the equity markets, which I think do reflect froth in the equity markets. But really, we try to stick to a framework for financial stability so we can talk about it the same way each time, and so we can be held accountable for it. So one of the areas is asset prices, and I would say some of the asset prices are high. You are seeing things in the capital markets that are a bit frothy. That's a fact. I won't say it has nothing to do with monetary policy, but it has a tremendous amount to do with vaccination and reopening of the economy. That's really what has been moving markets a lot in the last few months, is this turn away from what was a pretty dark winter to now a much faster vaccination process and a faster reopening. So that's part of what's going on. The other things, though, leverage in the financial system is not a problem. That was one of the four pillars. Asset prices was one. Leverage in the financial system is not an issue. We have very well capitalized large banks. We have funding risks for our largest financial institutions are also very low. We do have some funding risk issues around money market funds, but I would say they're not systemic right now. And the household sector is actually in pretty good shape. It was in a very good shape as a relative matter before the financial crisis. The pandemic crisis hit. There were real concerns, of course, with high levels of unemployment and loss of wages and all that the household sector would weaken dramatically. That hasn't happened. So with the fiscal transfers, money that's on household balance sheets, they're in good shape. You see relatively low defaults and that kind of thing. So the overall financial stability picture is mixed, but on balance, it's manageable, I would say. And by the way, I think it's appropriate and important for financial conditions to remain accommodative to support economic activity. Again, 8.5 million people who had jobs in February don't have them now. And, there's a long way to go till we reach our goal. So that's what I would say.
As a follow-up, you mentioned money market pressures. The Fed didn't make changes to interest on reserves or excess reserves. What was the logic behind that? It seems like SOFR has been drifting closer to zero. So just hoping for clarification on that.
Right. So the federal funds rate has been well within target and target range, and money market conditions are fine. We have the ability to use our administrative tools to make sure that remains the case. We do expect further downward pressure on rates through asset purchases and also the runoff in the Treasury General account. But at this point, we didn't see a need to deploy our tools to support rates. And of course, we will do so if the need does arise.
Thank you. Jean Young.
Hi, Chair Powell. I wanted to ask a similar question. We are seeing elevated market valuations, and some economists are concerned that the economy might overheat, at least for a period of time. So should the Fed and other regulators be thinking about tightening capital requirements or extending oversight to the non-bank sector so that financial stability risk stays as low as it has been? Thank you.
So I think capital requirements for banks are, to me, went up tremendously, really, over the course of the 10 years between the financial crisis and the arrival of the pandemic. And the banks really made it through a real stress test very well, and passed two of our stress tests, and then there's another one that's pending. Capital is in a good place as far as I'm concerned in the banking system. But to your point, what we saw was, so what kind of happened during the pandemic crisis that requires attention? And number one is money market funds and corporate bond funds, where we saw run dynamics again. And we're looking at that. So we're looking at ways, and people around the world are looking at ways to make those vehicles resilient so that they don't have to be, supported by the government whenever there's severely stressed market conditions. It's a private business. They need to have the wherewithal to stay in business and not just count on the Fed and others around the world to come in. So that was that. The other one is treasury market structure. Dealers are committing less capital to that activity now than they were 10 or 15 years ago, and the need for capital is higher because there's so much more supply of treasuries. And so there are some questions about treasury market structure, and there's a lot of careful work going on to understand whether there's something we can do about this. Because the U.S. Treasury market is probably the single most important market in the economy in the world. It needs to be liquid. It needs to function well for the good of our economy and the good of our citizens. So it's not clear where that takes you, but we are taking a careful look, and the Treasury Department is really going to be leading this at Treasury market structure and all of the various aspects of that to make sure that we do have a resilient, strong Treasury market that can work even in difficult times. As you know, at the very beginning of of this recent crisis, there was such a demand for selling treasuries, including by foreign central banks, that really the dealers couldn't handle the volume. And so what was happening was the market was really starting to lose function, and that was a really serious problem, which we had to solve through really massive asset purchases. And so we'd like to see if there isn't something we can do do we need to build against that kind of an extreme tail risk, and if so, what would that look like?
Thank you. Edward Lawrence.
Thank you, Fed Chairman, for the question. So I'm interested in your thoughts. There's so much fiscal help and accommodation from the Federal Reserve. You said today that vaccinations will follow the normal economic conditions or lead to more normal economic conditions later this year. When do you see the economy being able to stand on its own feet, so to speak? And along those lines, with the fiscal spending and the accommodation you talked about with transitory inflation, does more spending need to be injected into the system, or would that affect that transitory nature of the inflation? Thank you.
When will the economy be able to stand on its own feet? I'm not sure what the exact nature of that question is.
Well, what I'm saying is when do you need to lower the amount of treasuries you're buying, sort of taper off a little bit? When can it stand without having that support from the monetary policy side, and then further the transitory?
Okay, sorry. So we've articulated our test for that, as you know, and that is just we'll continue asset purchases at this pace until we see substantial further progress. And we're going to communicate well in advance of any decision. We're going to let the public know that that's what we're thinking, and so there'll be a lot of warning and that kind of thing. But it's about substantial further progress toward our goals. That's really all it is. It doesn't have any external virus-related specific requirement. Although again, I do think the virus will need to continue to be controlled for us to achieve those economic goals. But it's really the economic goals. Now, your second question, sorry, just say again, I didn't quite get that question.
Yeah, sure. With all the fiscal spending that's happened in the accommodation in it, does the system need more spending, either from the fiscal side or accommodation, or would more spending affect the transitory nature of the inflation and put those upward pressures on inflation long term?
So it's really up to Congress. We're not an advisor to Congress. You know, we don't weigh in on specific fiscal bills or proposals. That's really between elected parties. You know, basically fiscal policy is the province of people who stand for democratic election and win, and they get to make those very difficult decisions, and they get to be accountable to the voters. We didn't do any of that, and we don't have a seat at that table. We don't seek a seat at that table. So that's really something for Congress and the administration to deal with.
Thank you. Greg Robb.
Hi, Greg Robb from MarketWatch. Thank you so much for the opportunity. I wanted to circle back to the housing market. It's just kind of confusing the question and your answer. You know, the housing market is strong, prices are up, and yet the Fed is buying $40 billion per month in mortgage-related assets. Why is that? And are those purchases playing a role at all in pushing up prices? Thank you.
Yeah, I mean, we started buying MBS because the mortgage-backed security market was really experiencing severe dysfunction, and we've sort of articulated, you know, what our exit path is from that. It's not meant to provide direct assistance to the housing market. That was never the intent. It was really just to keep that it's a very close relation to the Treasury market and a very important market on its own. And so that's why we bought, as we did during the global financial crisis, we bought MBS too. Again, not an intention to send help to the housing market, which was really not a problem this time at all. So, and you know, it's a situation where we will taper asset purchases when the time comes to do that, and those purchases will come to zero over time, and that time is not yet.
Thank you. And for the last question, we'll go to Mike McKee.
Thank you, Mr. Chairman. Since I am last, let me go back to Paul's question, the first question, and ask you whether, not whether you're thinking of tapering, but why you're not. We're seeing bank lending fall. The markets seem to be operating well. Are you afraid of a taper tantrum, or is it, as one money manager put it, if you get out of the markets, there aren't enough buyers for all of the Treasury debt, and so rates would have to go way up? Bottom line question is, what do we get for $120 billion a month that we couldn't get for less?
So it's really not more complicated than this. We articulated the substantial further progress test at our December meeting, and really for the next couple of months, we're made relatively little progress toward our goals. And remember, substantial further progress from our December meeting. And then vaccination started to get more widespread. The economy reopened. We got a really nice job report for March. It doesn't constitute substantial further progress. It's not close to substantial further progress. We're hopeful that we will see along this path a way to that goal, and we believe we will, just as a question of when. And so when the time comes for us to talking about it, we'll do that. And but that time is not now. We're not that far. We've had one great jobs report. It's not enough. You know, we're going to act on actual data, not on a forecast, and we're just going to need to see more data. It's no more complicated than that.
Well, if you leave rates where they are, it doesn't change anything. But does it change anything if you actually tapered a bit? If you spent less, would you still get the same effect on the economy?
If we bought less, you're very faint. So if someone has a volume, they turn it up. But if we bought less, you know, no. I mean, I think the effect is proportional to the amount we buy. It's really part of overall accommodative financial conditions. We have tried to create accommodative financial conditions to support economic activity, and we did that. And we articulated the tests for withdrawing that accommodation. And we think, you know, so we're waiting to see those tests to be fulfilled, both for asset purchases and for lift off of rates. And when the tests are fulfilled, we'll go ahead. As we've done this before. We did it in the last after the last crisis, and we'll do it as those tests are satisfied. We'll do it, and the only thing that will guide us are the tests met? That's what we focused on, is have the macroeconomic conditions that we've articulated, have they been realized? That will be the test for tapering asset purchases and for raising interest rates.
Thank you very much.
Thank you.
Fed Chair Jay Powell wrapping up that press conference. He's been give about a 6-minute speech coming off the announcement. Began speaking at 2:30 and just wrapping up here just shy of 1 hour. And I think some of the highlights, I guess, Tim, safe to say, are, first of all, we know headline, what we got is what we were all forecasting. No change in rates, continuing those bond purchases, those monthly numbers, everything staying the same. Markets, for the most part, took it all in stride. We didn't see too much of a change, but I will say, when he did say some things in equities do reflect froth in markets, we did see equities take a little bit of a dip down, so we did see some reaction there.
That was in response to a question about Dogecoin and GameStop speculation. So he was asked about that, which isn't that surprising given what we've seen in the equity markets and what we've seen over the last 6 weeks in crypto.
Right. And again, stressing upward price pressures are likely to be temporary. He really stressed too, and this is something Ira Jersey of our Bloomberg Intelligence team talked about, the labor market. Yeah. He's watching the labor market. So too is Fed Chief Jay Powell. And he said if labor market were tight, wages would be rising. In the last expansion, the labor supply showed up. And pre-pandemic, just before the pandemic hit, we did see lower level jobs. We saw wages going up there specifically. So, he talks about we are a long way still from being back where we are. Still a long way from full employment, long ways to go. Those were his words. It will be also, he said, a different economy on the other side. And he said quite likely those people that had some of those service sector jobs, they're going to have to find other jobs, and it's going to take time for them to do so. They're going to need help because automation, we talked about with John Taffer yesterday, in the restaurant industry, there's a lot more automation that's going to be in that industry, specifically replacing people who used to do those jobs.
That's right. And one thing that I said I would be watching closely and listening for closely is any commentary about the housing market. And Powell was asked about that and said there is no bubble in housing, but housing prices are going up and the Fed is watching this carefully. He said, quote, "My hope would be that over time housing builders can react to this demand and come up with more supply." It's something that home builders are certainly trying to do. Easier said than done. Right. It takes a while to build homes. There's only so much land. And of course, those inputs, lumber and then labor as well, have been tough over the last year.
He said, bottom line, no financial instability concerns around housing. All right, that is the Fed chief, his statement, the press conference. Let's get a check on the markets for you, some other top business stories, because we got a lot of tech earnings coming your way in just about a half an hour. Charlie Pellet, where shall we begin?
Right now, let's begin with the numbers. 33 minutes to go ahead of the closing bell. S&P 500 index up 4 right now, a gain of 1/10%. We've got the Dow down 105, a drop there of 0.3. NASDAQ lower now by 2 points, little change, down less than 0.1%. 10-year yield 1.61%. Fed Wednesday, stocks swinging between gains and losses. Treasuries turned higher after the Federal Reserve maintained its support for the economy. Here's Fed Chair Jay Powell. You heard him live right here on Bloomberg Television and Radio.
Today, my colleagues on the FOMC and I kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete.
Reaction from Lindsay Pieggs, the chief economist at Stifel Nicolaus.
The policy decision very much in line with expectations in terms of asset purchases and rates. I did like that the Fed acknowledged the recent improvements in the domestic economy. I think that helps the committee maintain their credibility, that they're not completely ignoring the steps that we have taken in the right direction.
And again, 10-year yield right now 1.61%. Gold up 0.3%, 17.81 the ounce. West Texas Intermediate crude up 1.5%, 63.87 a barrel. Earnings front and center. One of the busiest days of the year in terms of those key reports. Apple after the bell. Right now, down little change, down by 4 cents. We've also got Facebook after the bell, up now by 1.8%. Recapping, NASDAQ just turning positive, up 2 points. S&P up 5, up 1/10. The Dow down by 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I love me some Fed Wednesday.
I do too.
Right?
Getting into it.
Yeah, it's just kind of a nice check. I like to hear from Jay Powell what he has to say. So let's see what our guests have to say about that latest Fed decision. Back with us, Steve Skanke, Chief Economic Advisor at Keel Point, former U.S. Treasury and White House National Security Council staff member. Based in Washington, D.C., he is on the phone in Florida on this Fed Wednesday. Also with us, Bloomberg Economics Chief U.S. Economist Carl Riccadonna, and he is on the phone in New Jersey. Carl, I'm going to kick it off with you. I feel like this was, to some extent, an easy one to predict, right, in terms of what the Fed would do, and basically they did nothing.
Carol, the paint is officially dry and the grass has grown, so we can close the book on that one.
Yeah.
This was largely expected to be kind of non-event Fed meeting, but I think there is some important nuance to be had from it. First of all, the Fed made some very straightforward acknowledgments that the economy is improving, especially those hard-hit sectors are coming back. And they acknowledged the pickup in inflation pressures. But the fact that the Fed is just sticking to the same playbook that they've been using for quite some time now tells you that they are confident in their assessment of the economy, that A, the economy is coming back in a robust fashion, but also B, that we are not seeing an unmooring of inflation pressures in the economy. The statement explicitly stated largely reflecting transitory factors as they talked about the pickup in inflation. So this is a Fed that is not panicking. And the final point worth noting was that Chair Powell said it is still not time to even talking about tapering asset purchases.
Not even time.
So just stop it.
Don't ask me any more questions about it. Steve Skanke, come on in here and give us your reaction. Are you thinking similar to the way Carl is thinking? They're relatively non-eventful, but still some nuance in it.
Yeah, absolutely. And thanks for having me on. It's interesting. It would be hard to expect that they were going to do anything. It was not their intention to do anything. The big risk was that Chair Powell might say something that would be misinterpreted. But even within that, markets were really expecting that they'd have something from them. That maybe, the good news in the March employment, almost 1 million, or a little bump up in headline inflation would trigger something. But he pointed out near the end of the press conference, he said, we're waiting. We said in December, we're waiting for substantial further progress toward our goal, and we haven't seen it. 1 month of good employment numbers is not substantial further progress. And I agree with Carl. They're confident of their take on the economy, and I would just add that they're confident of their plan. That as it fits in with the fiscal program, the public health program, that they're moving along in a good way.
And I have to say, I found it really interesting, too, his focus on the labor market, Carl, because he said, we're still a long way from full employment, a long ways to go is what he said. And if we think about just before the pandemic, right, we were seeing tightness. We were seeing wages, among those lower level jobs going up. And we're a long way from that, Carl.
We are certainly a long way from that, Carol. Now, back when Janet Yellen was Fed chair, we talked about her dashboard of labor market indicators, and you could envision lots of flashing lights and gauges and dials and different things she was looking at. And that's what happens when a PhD is at the helm of the Fed, right? There's lots of complexity. Jay Powell is much more straightforward. There is one key barometer he is continuing to beat the drum on, and that is the jobs deficit where we are now relative to where we were pre-pandemic. Now, it's an imperfect metric because the economy grows, the size of the population grows, there's more workers now than there were last year at this time, as we see from the latest census result. We are 8.4 million jobs below where we were in February of last year. That means that we need to see March times 8 or 9 to really be absorbing the slack that Jay Powell is so focused on. When we get to that point, we should see an unemployment rate at 3.5%, and we'll see the very early signals of wage pressures that we were starting to see just hints and whiffs of before the pandemic wreaked havoc on the economy.
It's so interesting because we are hearing anecdotal reports of wage pressures. I mean, Chipotle's CEO telling us last week that it's hard to keep people employed. There's in the current issue of Bloomberg Business Week, there's a story about Uber and Lyft drivers, and customers are returning faster than Uber and Lyft drivers are willing to return and willing to drive right now. And as a result, Uber and Lyft are having to actually pay incentives in order to get those drivers on the roads. So why is there this disconnect when there are so many people who are unemployed, but companies still are finding it difficult to actually get these people, Carl?
Well, Tim, that's the beverage curve, as economists call it. It's the mismatch between demand and skill set at any point during the economy. But we're seeing this now as we see this, very rapid reopening. The U.S. economy is geared to grow at about a 2% pace. It's going to grow 7.7% in the current year. So, of course, there are frictions and bottlenecks. But there's lots of industries that are not seeing significant wage pressures. And so as we look at measures like average hourly earnings or the employment cost index, which is out this Friday, we're just not seeing an alarming pickup in wage pressures that would really signal that this could be something with a little bit of staying power. And the footnote I'll add to this question is Labor Day. So as we think about Labor Day of this year, it will be September when a lot of these expanded unemployment insurance benefits expire.
Right.
At that point, for a lot of folks, it will make more sense to go take a job paying $12 or $15 per hour than to continue to collect unemployment benefits. So there is a little bit of a sustained impact from the economic downturn and the special measures that were put in place to help prop up the economy in the interim. It's not timed perfectly, the expiration, but I think when we see September roll around, you will suddenly see a little bit of a change in the dynamics around labor supply.
John Taffer, Bar Rescue, that's exactly what he talked about. He works with small businesses, restaurant owners around the country, and he said part of what's really hurting restaurant owners right now is that workers don't want to come back because they've got stimulus money, they've got unemployment benefits, and they're okay kind of riding it out a little bit more. Steve Skanke, one of the things that in your notes that you shared with us ahead of the Fed meeting is, markets being surprised at the Fed's patience, but it does seem like markets are kind of, for the most part, taking risks to guide them in terms of what they do next. What do you take of kind of markets being kind of okay with this?
Well, it's a little bit of what can they really do? What can they really say? And the truth is, when Jay Powell pointed out that they're looking for a string of $1 million job growth months, and as Carl pointed out, that's 7 or 8 before we get back to the number of February of last year. This job deficit that doesn't even take account for the growing of the labor force naturally, irrespective of what the participation rate is. But month by month, we're going to see greater tension factoring into this surprise at the Fed's patience. I think what's really interesting and different about this is that historically the Fed has always reacted on forecast information, and at their last meeting they were very clear to point out we're waiting to see actual results. We want to see it passing in front of us. Not hearing what the forecast is,
right?
And that's a big difference, and one that's not fully accepted yet. The other thing is this Fed in particular, and Jay Powell has talked about it several times, even before the pandemic, that they are just acutely aware that that employment and job growth and wage growth reaches the disadvantaged and minority labor sectors only late in the economic growth cycle, and that the Fed has as its full employment goals job benefits for this broadly diversified cross-section or all sectors of the labor force. And so they are going, we're going to see that they are going to wait longer than anyone expects and let the inflation side of it run a little bit hot so that all of those folks who have been disadvantaged and put out of their jobs or retired or left the labor force or whatever until they've had an opportunity really to experience the rebound. And what's also different now than it was a few years ago is that we have today a Congress, and certainly for the next 4 years, a White House that is very much behind that patient waiting to get those employment benefits and wage growth benefits pushed out as broadly as they can before we become very concerned about inflation.
Hey, I think that's a really good point. Carl, just got about 45 seconds left here. Our Fed Live blog talking about a Goldilocks economy. It almost feels that way, and it certainly feels like if I look at both the equity and the Treasury market in terms of reaction, they seemed really comfortable with where we are, where we might be headed over the next few months. How do you see it? Would you use the word Goldilocks?
I'm not going to use Goldilocks because I'm going to stick to that barometer that Chair Powell mentioned. 8.4 million individuals who had jobs last February are now sitting on the sidelines of the labor market, and that's causing skill atrophy and missed benefits, missed 401k and retirement.
Not Goldilocks for them, right?
All sorts of problems. So it's not quite Goldilocks just yet. And to summarize Steve's point, in terms of the inflation outlook, back with Bernanke and Yellen, it was looking for the whites of the eyes of inflation. Now it's looking for inflation's tailcoats.
Well said, both of you. What a perfect little roundtable. Thank you, guys, and be well. Steve Skanke, Chief Economic Advisor at Keel Point, former U.S. Treasury and White House National Security Council staff member, joining us on the phone in Florida, and our own wonderful Bloomberg Economics Chief U.S. Economist Carl Riccadonna on the phone in New Jersey. All right, let's get another check on what's going on in the world of business. Let's go. Oh, world of national news. My mistake. Hey, Nance, take it away.
That's okay.
Sorry.
That's okay. Well, President Biden is calling for raising taxes on the wealthiest Americans to help fund his American Families Plan. He's expected to talk about the $1.8 trillion plan when he addresses a joint session of Congress tonight. That'll be carried live right here on Bloomberg Radio. Our coverage begins at 8:30 Wall Street time. Bloomberg's Emily Wilkins says this proposal will involve extensive discussions.
The kickoff speech is tonight for the second part of this plan for the tax proposal. Congress already has some ideas of what changes they'd like to make. Leaders already have an idea of where members in their caucus stands. And I think we're going to be seeing Biden's proposal get tweaked a little bit as lawmakers get their hands on it and it starts going through the legislative process.
Wilkins says look for moderate Democrats like West Virginia's Joe Manchin to be the ones offering changes. Rudy Giuliani now has fewer secrets following a raid on his home and office this morning by federal agents. They seized computers and cell phones in a major escalation of the Justice Department's investigation into the business dealings of former President Trump's personal attorney. A judge in North Carolina has denied a request to immediately release the body cam video of the police-involved shooting of Andrew Brown. But Judge Jeffrey Foster is allowing the family to view the video.
The disclosure of the video shall occur within 10 days, and the Pasquotank County Sheriff's Department is ordered to blur or redact all facial and identifying features of the officers.
Foster says the public can see the video within 45 days. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Now back to you, Carol and Tim.
Thank you, Nancy. This is Bloomberg.
Going a little country on us?
Not at all.
Is it Jethro Tull?
It is.
How'd you know?
Because it just had that feel, but it's not one that I'm familiar with. My sister Evelyn was really into Jethro Tull. Take us a break and all that. But what song is this one?
It's called For Michael Collins, Jeffrey and Me.
Oh, gosh.
So now you know why I played it.
Which?
Because Michael Collins, the third man, as the New York Times described him, as the Apollo 11 mission, died today at the age of 90.
Right. Isn't that like, that whole era, the space missions, right?
Yeah, absolutely.
What album is that from? Sorry, going back to... Benefit, okay.
Yeah, so pre-Aqualung, big name Jethro Tull, but definitely a good early record by my judgment anyway.
My understanding is Ian Anderson didn't know how to play flute, and I think just taught himself how to do it or something. Like, you feel like it was just in his blood, but I think it's just something he picked up. Isn't that wild?
There you go.
Okay.
And certainly it distinguished Jethro Tull's sound. You don't find too many flute players in rock bands.
No, but who am I thinking of?
You're looking at me like I know the answer.
Lizzo. Like, Lizzo's incredible.
Yeah.
I love when Tim, you should see the look. Wait until you're back in studio, Dave.
It's literally all Greek to me, Dave.
Tim just looks at me like, I don't know where you're going with this. All right, Dave, we do know where we're going.
This is a fun chart. We got a fun chart today.
We are going to the chart of the day. What do you got, Dave?
Yeah, well, it's an interesting sort of contrast. It's funny. I was going through my research today, as I always do, and I found this note from DataTrek, Nick Colas's firm, and he was pointing out that, back in February, he'd written about Tesla when they decided to invest in Bitcoin and basically sort of put a trade idea out there, it's sort of in jest, but nonetheless, that it was time to buy Bitcoin and sell Tesla stocks short. If you'd done that, as it turned out, you would have made out just fine because, we got this reminder yesterday of the fact that, Tesla has managed to make money on Bitcoin. We know that they had a $101 million profit in the first quarter, but their shares have not followed the lead of Bitcoin. There has been no coattail effect, you might say, from the decision to invest in the digital currency because, as of yesterday, you go back to February 8th when Tesla first disclosed in their annual report that they put $1.5 billion into Bitcoin. And from that point through yesterday, you had a 17% drop in Tesla's shares. And over that same period, Bitcoin was up something like 43%. So much for playing follow the leader, that's for sure. I mean, even though Tesla's investment it has paid off, at least to some extent. Colas was making the point back in February, if Tesla thinks that Bitcoin is a better investment than its own business, what does it say about the business? And you could argue that's how things have played out, given the performance of the shares relative to the performance of the digital currency. If you want to know more, folks, send me an email. I'll get you the chart, the explanation that goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
Dave Wilson, Stocks Editor. You can look for Dave's Stock of the Day just after 4:15 p.m. Wall Street time. It's on Facebook, it's on LinkedIn, and it is on Twitter. Dave, thanks so much. Let's get a check on the business trading day with Charlie Pellet with the latest headlines. Hey, Charlie.
Thank you very much. We've got 12 minutes to go ahead of the latest numbers out of Apple and Facebook. We will be all over those numbers as they break. S&P on track for a record. Right to the numbers. We'll give you some color in a moment here with the S&P up right now by 3 points. That is a gain of 0.1%. The Dow down 115 points, down 0.3%. NASDAQ lower as well, tumbling 5 points now, down by about 0.1%. 10-year yield 1.61%. Gold up $3 the ounce, up 0.2% to $17.80. West Texas Intermediate crude up 1.5%, $63.91 a barrel. Stocks are trading mixed, swinging between gains and losses. Treasuries turned higher after the Fed maintained its support for the economy. Policymakers strengthened their view of the economy and said that recent increases in inflation look, quote, transitory. And in a news conference you heard live here on Bloomberg Radio, also aired on Bloomberg Television, Fed Chair Jay Powell addressed the pandemic and the economy.
Since March, progress on vaccinations has limited the number of new cases, hospitalizations, and deaths. While the level of new cases remains concerning, especially as it reflects the spread of more infectious strains of the virus, Continued vaccinations should allow for a return to more normal economic conditions later this year.
Ahead of earnings, Apple shares now down by 0.4%. Ahead of earnings, Facebook up 1.6%. Recapping equities mix, 10-year yield right now 1.60%. S&P holding on to a 2-point gain. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Yes, indeed. Just about 10 minutes left in the trading session. What a blockbuster day. What a blockbuster week. Lots of big tech earnings. You've got the Fed meeting, of course, today. Looks like equities firmed up a little bit following that Fed meeting and Fed press conference with Jay Powell. But nonetheless, the trade pretty much where it was pre-Fed announcement. Let's get to it. Let's do the drive to the close with JJ Kinahan back with us. He's chief market strategist at TD Ameritrade here on the phone in Chicago. Hey, JJ, how are you?
Great. Thanks for having me.
Well, good to have you. Where shall we begin? What's your focus on? Is it Fed, what Jay Powell had to say? Has it been on these big tech earnings? Is it earnings in general? I'm just curious. What is it like you get up in the morning and what you want to know, besides maybe what you're having for breakfast?
I still think it's earnings, Carol. Earnings ultimately drive stocks longer term. The Fed today, as you said, we had the initial pop, but I don't think they really told us anything we didn't already know. This is one of the few times, coming into the week, especially over the last few Fed meetings, where I thought the Fed might be the third most important story of the week behind all these big earnings, GDP, and the Fed, because I think there was an expectation that they really wouldn't say anything, and I don't think they necessarily have. Not a criticism, just, that this is how they're sticking to the script.
So it's a market that's now focused on earnings, right?
Yes.
Okay.
Absolutely.
So to that end, one thing that's interesting that's played out over the last few weeks for the first quarter reports is that many companies have reported a significant beat in the top and the bottom line, but as a result, the company's stock hasn't moved significantly. So talk a little bit about expectations versus reality and what investors want to see in order to move the company's stock.
Yeah, I think it's a great point, Jimmy. You really had to destroy earnings to get an upside here.
Yeah, look what happened to Tesla.
Look what happened to Goldman Sachs. Tesla. You're right. I mean, Goldman Sachs to me they got up, 2% on the day, and they had an unbelievable quarter. You did see stocks like UPS, which were able to overcome this, but overall, people talk about low expectations. But one thing I will say in this earnings season, if you did not beat revenue, you had absolutely no chance. It didn't matter what you said besides that. You had to beat revenue, and you had to paint a really good picture going forward. The other thing about it was if you had a good run-up over the last couple of months, you weren't necessarily going to get rewarded for good earnings. That's actually okay. People are like, we need a sell-off, et cetera. Doesn't this, for those who've been calling for a sell-off for a long time, when you have really good earnings from a lot of companies and you don't have a sell-off, it kind of works the same way a little bit. It's people taking a breather, reassessing.
Yeah, let's be real. I mean, Tesla was up 743%. 743% last year.
That's what you call a good year, Carol.
That's what I call an unbelievable year. Like, if I don't do anything for the next 5 years, I think I'm pretty good. So, take a breather.
And I think that's what you're seeing is people, taking a breather and saying, okay, what should be our realistic expectations for going back, the economy reopening? And we're continuing to see that tug of war, if you will, between the stay-at-home stocks and the economy opening up stocks. I think people are still questioning which way should we go right here. Is it too early to sort of toss away those stay-at-home stocks? And it certainly doesn't look that way.
So What are you thinking about in terms of themes that have emerged, especially with this week when we've seen so much come from big tech? We've talked a little bit about inflation in the context of rising input costs and those being passed on to consumers, especially with regard to the companies that we heard from last week, but even the companies that we're hearing from this week. What are the big themes that are sticking out to you when you were hearing from these companies and the way that they're thinking about the economy and they're thinking about inflation?
I actually think it's for the companies themselves. I'll talk about inflation in a moment if you don't mind, Tim. I actually think it's a pretty good message. You know, you see things again. Another stock down today, Microsoft. Pretty good message overall, though. They're very much believers in everything that they're doing going forward. I think the takeaway for me has been tech, very healthy. Again, a breather, but longer term, still a lot of growth opportunities as the economy returns to, and I'm using air quotes, normal. The inflationary concerns seem to be real. You look at the raw commodities themselves, like corn, soybeans, et cetera, gone up quite a bit. Then you have the Procter & Gamble's and the Coca-Colas of the world talking about raising prices. You had JetBlue talking about fuel prices being higher. So many have called for fourth quarter pressure on inflation. I certainly don't think that's off the table.
All right. So what would you be buying in this environment? What would you be selling?
Well, I think the most interesting area to me, and it's been for the years so far, is still financials. I find it hard to believe if you're looking for, out for the year, they had a very good quarter overall. Those that have trading arms took great advantage of the trading environment. And it's just hard for me to believe that we don't continue to see rate pressure throughout the year, whether brought on from the Fed or just market pressures overall. So I still think that's the most interesting area overall. The area that probably is, I don't know, a little bit more, shall we say, unclear to me is energy, because even though I know I'm
which is on fire today,
and I know I'm talking about inflation on the one hand, but crude oil just can't seem to get out of its own way once it gets above $65.
So here we are in the midst of earnings. It's my favorite time of year. Carol knows it. It's my favorite week of the quarter right now.
Time of the year.
It is.
Favorite time of the quarter, I should say. We
Nothing
get it
under
4
the
times
Christmas
a year.
tree, but still, it's a lot of fun.
It is a lot of fun. Why do you think still we're having so much trouble hearing from CFOs about outlook? And not to harp on Tesla, but that was really what drove the company's stock down, right? It was the fact that it wasn't willing to give guidance. And it does seem that there's a lot of uncertainty still.
It does, but think about all the companies. I know our company's going through it. I believe yours is. What's our back to work policy?
Oh, we're here.
Go forward.
We're here.
No, I know you are, but not.
No, I know what you're saying.
Yeah, so I think that has a little bit to do with it. Also, is companies are still struggling with so much. There's probably there will be more pressure on companies to allow more freedom for people at work. So how do you take that into the routine you had before? It's one thing when everybody's at work, one thing when everybody's at home.
Right.
And when you have this mix of some at home, some at work, that's where you can start to get a little bit of slippage, if you will, in communication, which is hard enough as it is. So I think that really a lot of the companies are just trying to figure that out. And, for the automakers, I think the chip shortage is starting to play into that also as they try and figure out. We had Intel CEO talk about 2 years.
Right.
It's a long time.
Well, and we'll find out what Ford has to say when they report earnings after the close. JJ Kinahan, good to check in with you. Chief Market Strategist over at TD Ameritrade, joining us on the phone from Chicago. Here comes Beyond the Bell.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are just 2 minutes away from the end of the trading day, a Fed trading day, an earnings trading day. Caroline Hine here, Taylor Riggs with me, counting you down to the closing bell. Here to help us go to the Beyond the Bell is our global simulcast. We are joined now by Carol Masser, Tim Stenovic, bringing together our Bloomberg television, radio, YouTube audiences worldwide to, pass through one of the crucial moments of the day. Carol, it had to be really the Fed managing to keep that Goldilocks running?
Oh my God, that's exactly what we just talked about with our guests on Bloomberg Radio. It is a Goldilocks economy. Take a look at how the market reacted. We had a little bit of firming in the equity trade following the Fed decision and Fed press conference, but the yield curve pretty much staying put where it was pre-Fed decision. And I agree. I think the outlook, we all know the Fed's going to be patient. They're waiting for their metrics, Tim, to kind of hit before they make any changes in policy.
Yeah, look, it absolutely makes sense because the Fed strengthened its view of the economy, said those recent inflation looked, quote, transitory. I lost count of how many times Fed Chair Powell said the word transitory, not just in the, in the headlines, but during that press conference. But one point that Carl Riccadonna made on our show was that when it comes to thinking about that metric, it's all about those folks who still remain unemployed, those 8.4 million people who are sitting on the sidelines and have not come back into the workforce yet. That's what he's keeping an eye on for looking for economic growth and economic recovery.
And that's indeed what you see within the equity markets, walking that fine line between gains and losses, showing some losses, of course, Caroline, as we head into the closing bell here in the bond markets. They catch a bid. We get some of that migration downwards as we're seeing some growth expectations come back, but we remain in check. We are lower for longer.
It really is a complete round trip from the minute the Federal Reserve announced its press release and then went into its press conference. We managed to push higher on some of the stock markets across the board. We had NASDAQ up about 0.3%. You had a push into the S&P 500, but now we end the day lower, just by 2.9 points on the S&P 500. We've still got to finish up settlement here, but it looks like we're going to close down by 1/10%. The NASDAQ, big tech, down 0.3%, and we're already getting earnings out from some of that big tech. Carol, Qualcomm.
Yeah. Qualcomm crossing the Bloomberg terminal, talking about the second quarter adjusted EPS of $1.90 a share. Folks, that is a big beat compared with the estimate of $1.67. Second quarter adjusted revenues, $7.93 billion. That too is better than what Wall Street was forecasting, $7.63 billion. And it's also talking about the third quarter, always key. Third quarter revenue, they're looking for $7.1 billion to $7.9 billion. The estimate out there is $7.12 billion. So, this is what we want to hear, Tim. We want to hear about outlook. Qualcomm, though, you can see in the after hours, investors like it, up 3.7%.
Yeah, they do. And look at that. It's had a rough year so far. The company, of course, makes chips, and it has been trying to increase supply and meet the demand, as chips have been in great supply, not just over the last year, but increasingly they're found in pretty much everything right now. One thing to think about, too, when it comes to Qualcomm is any guidance or any sort of insight into the rest of the world, where it sells, in China and South Korea, and just a small portion here in the U.S.
And Tim, we continue to see some of these earnings. We've been talking about this talk for a while. Align Technology seeing full year net revenue now between $3.7 billion to $3.9 billion. That is well ahead of the estimates of just shy of about $3.5 billion. So you're really seeing that full year guidance on that revenue, Carol, really come in better than expected. This is also as they've seen improvement in the first quarter as well. That revenue at $894 million versus estimates of $820. So an improvement really across the board.
It's kind of interesting. This is a pre-pandemic play too. Like, this is a stock that people are thinking about consumer, their own health care, their own personal care. And so this is the Invisalign braces. The stock has actually been doing pretty well this year. We're talking about being up about 16%. It's got a $48 billion market cap. It's as big as Ford, Caroline, which is also going to report earnings after the close.
Hey, braces are big business, okay?
They are.
They are when you've been staring at yourself on a Zoom conference for the past year and suddenly realizing maybe you're more scruffy than you thought. But we await, of course, some other key earnings. Taylor, we're going to be digging into the likes of MGM. We've got the likes of Ford, as we were just mentioning. The key for me, Facebook and indeed Apple at the half-past mark.
100%. We're going to be all looking here at Facebook. I've been just reading some analyst notes all day. Raymond James looking at ad growth up 34% on a year-over-year basis. Also some commentary from Canaccord Genuity on those social audio strategies, Tim, as you've really wondered if this is a push that we've seen just during lockdown, or if this social audio is actually something indeed that can last in a post-pandemic world. All of those, of course, relative to Facebook and the strong advertising that we've seen from the likes of Alphabet, et cetera. Does that see a read through?
Yeah, that's certainly a big question. Mark Zuckerberg himself has been spending quite a bit of time on Clubhouse, actually talking on the app and getting to know the app. Look, a big question I have about Facebook is what it says about iOS 14, right? That's Apple's new operating system. And it's the one that includes the warning. You might have seen it now already about how other apps are tracking you. Facebook has come out against that in a very significant way. But the question is, as to what extent does it actually really hurt the company's business when it comes to odd tracking and, of course, online ad revenue. Also, viewing Facebook in the context of yesterday's huge beat when it comes from Alphabet, especially with that YouTube revenue, but balancing it out with what Pinterest said, that we could be past peak social, at least during the pandemic.
And of course, this all moves us towards what's Apple going to say, of course, still the key, most valuable company out there. And they're going to be not only speaking to the narrative that we see of managing to tick the box on services as well as products. What will we hear in terms of iPads and in terms of Macs? Are we all still working at home, thinking of schooling? Will that be sustainable in terms of growth? But also, Taylor, tax commentary. This is a company that's just come out at the beginning of the week to say that they are paying the most amount of tax out there. And this is as we hear from President Biden later today, 9 p.m. New York time, about potentially big tax increases for Wall Street, largely.
I might get in trouble if I say the only thing I learned during my time in San Francisco was the fact that Tim Cook is by far the best big tech CEO, Carol, in navigating the political changes. You had Amazon, Jeff Bezos. Well, Trump didn't like him, but you have Tim Cook touring that Texas factory right after the previous election. And then, of course, you get a signaling with the current administration about, hey, we are the largest taxpayer, $45 billion in taxes in the previous 5 years. How do you navigate those relationships, perhaps getting ahead of that political spectrum? It is all about hardware with Apple. It's all about politics, Caroline, like you said, that tax conversation and how you push that forward, Carol.
Well, what's interesting, too, is that I think it is about a lot of things when it comes to Apple. But, you know, investors are looking for something to move the stock. The stock has gone nowhere this year. And so investors are looking for something that ultimately gets it moving. Do you want to mention, though, Ford crossing the Bloomberg terminal, Tim?
Yeah, we're keeping an eye on what's going on with Ford. Ford shares closed down 0.6% after.
Okay, traders, Bitcoin. As you can see, it moved up from 54,856, and I am going to place stop on profit 1% to 55,405. Okay, so you guys, if you follow the trade this afternoon, I think about just a couple of hours ago, if you decided to trade with me, Bitcoin right now is the chance to place stop on profit, and if it turn around, you will gain 1% from trading Bitcoin. Okay, let me see, maybe I'll be able to place even higher stop on profit 554,856, because to be honest, overnight charge for Bitcoin will be quite high. For all of you guys who traded on margin before, they know that if you go long overnight, you have to pay to broker overnight charges. If you sell short, broker pays you overnight charges. Because we're long, it's better probably to sell it. Let's see, 54,856 plus 2%, 55,935. Let's do 2%, 54,856 plus 2%. It will give us 2,000 pounds in profit, and I will place stop on profit to 55,953. Just right here at 55,953, stop on profit. Even 55,954. Okay. I place stop on profit. So all of you guys, if you don't want to hold overnight, I do not suggest you and advise you to hold overnight. And at the end of the day, I'm not working to give you advice. It's your decision. We're trading our own funds, so we make our own decision. You're just following our trades. So we purchased where? Just right here at 2 o'clock. Okay, and I placed a stop on profit at 54,954, 2%. I'll speak to you later, guys. If you want to get the strategy, please go to company.co.uk website and you need to buy the strategy. It's not free. We don't give strategy for free. If you're looking for free strategies, you better use other schools or other people who give you free strategy. This strategy gives you profit, so you have to pay for this knowledge and for the strategy. I'll speak to you later, guys.
And they want to see that, Caroline, contributing to the bottom line.
Regulation as well, which I
Yes.
think is front and center for most of these platforms now, sees high ad targeting headwinds on platform changes, of course, but they're also seeing high ad targeting headwinds on regulatory changes as well. This is a company that sees Apple changing the game in terms of, well, whether you're going to be signing in to be able to see, to be understanding the way in which you navigate, the way in which adverts that you could respond to, but also how regulators might be adapting to that as well. Overall, they see ad revenue growth was mostly driven by price through 2021, but we'll see how they continue to fare for the rest of the year. Hey, Taylor.
You know, there's a raging debate, Caroline, going on about CapEx spend. I was reading a note from MKM Partners saying that some of the big debates around Facebook is if they're going to lower their OpEx and their CapEx guide for 2021. And indeed, they don't. They say $70 to $73 billion for this year. Prior outlooks were $68 to $73 billion. So I'm hearing a lot of that investment spend, that increase in that ad environment, talking, of course, as you mentioned, some of those headwinds around the iOS changes, but they're looking at that not until 2Q.
All right, maybe lots of debate about that. No debate about the share price, though, because it's up more than 4.5% here in the after hours. So we'll see if that carries over into the regular trade today. All right, guys, that's going to do it for Beyond the Bell on this Wednesday. Our cross-platform coverage on Bloomberg Radio, Bloomberg TV, and on YouTube. We'll see you again tomorrow. Same place, same time.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, no doubt about it. It's been a big day, a Fed day, but right now our focus, I know, I love it when there's lots of news. Facebook shares up 4.5% here in the after hours. Investors liking it. Listen, we knew, Tim, it was going to be blockbuster numbers because the comparison a year ago was a rough one if you think about where we were, and then we saw certainly Facebook take off.
Yeah, the company's saying that in the second quarter, revenue growth should remain stable, modestly accelerate. 2021 capex, 19 billion to 21 billion, saw 21 billion to 23 billion, so a slight decline there. Facebook sees 2021 total expenditures of more than $70 billion. That is just in line with expectations.
Got one of our headlines now in the after hours, and certainly will continue into the Thursday trade. All right, you are listening to Bloomberg Business Week. You're heading out.
I'm heading out. I'll see you tomorrow, though.
All right, see you tomorrow. We'll have a lot to cover again. Let's get a check on world and national news. Over to Nancy Lyons we go in our D.C. studio. Hey, Nance.
Hey, Carol. President Biden is likely putting the finishing touches on the speech he'll be giving tonight, outlining his American Families Plan. It includes proposals to expand educational opportunities and child care. The price tag, $1.8 trillion, which he wants to fund by raising taxes on the wealthiest Americans. Well, the president is also expected to use his speech to Congress to call for stricter gun laws.
A White House official says the president will characterize gun violence as an epidemic and urge action on two bills that have passed in the House that would strengthen background checks. A Washington Post ABC News poll finds 50% of Americans support new gun laws. That's down from a peak of 57%, which followed the Stoneman Douglas High School shooting in Parkland, Florida back in 2018. Michael Bloomberg, founder and majority owner of Bloomberg Radio parent company Bloomberg LP, donates to several gun safety groups, including Everytown for Gun Safety. In Washington, I'm Nathan Hager, Bloomberg Radio.
Coverage of Biden's address tonight begins at 8:30 Wall Street time, right here on Bloomberg Radio.
How do you like that? Position closed at 55,954. We made a profit 2%. Well done, guys. All of you who followed my trades, you did really well. Look, you made 2%. New guys who I just seen a couple of emails we received that new guys joined our team. And well done. First trade, first day, and you did really well. In our case, 2% gives us £2,000. In your case, it's all about how much broker pays you per pip. Let's move on and look for next opportunity to trade pairs. And again, I want to remind, if you want to get the strategy, if you want to find out how come we don't lose money, how come we trade so precise and so profitably, you need to get the strategy. Strategy is not free, and you need to get it from our website, company.co.uk, or you can get it from this streamer, from this channel. We trade our own money. We don't trade imaginary money. We trade our clients' money. So it's all happened live in front of you. Right now is the time, 15 minutes past 9 evening. So we stay late. Sometimes we stay overnight because market never sleeps, especially Forex. Some people go for weekend just on Friday until Sunday, and they come back at Sunday evening. Okay, guys. Good trade, well done, and I'll speak to you later.
About 4.7% in the after hours. For some insight, as only he can do, is Bloomberg radio host Paul Sweeney, who hosts 20 shows here at Bloomberg.
They keep me busy. It's a lot of fun.
I know, and you do it well. This feels like a blockbuster quarter. We knew, though, the comparisons were going to be somewhat easy, right?
Yeah, we did it. This really is, as the analysts like to say, a blowout quarter. I mean, you think about a company that's got $26 billion of quarterly revenue. To grow that 47% is just extraordinary. And they did it the old-fashioned way. They raised prices by about 30%, and they sold 12% more ad units. And so that'll add up to a really good top line. And then the profit margins were so much better than the street had been forecasting, which led to a big EPS beat as well.
Did you feel like after you saw Google's numbers yesterday, you knew that Facebook was probably going to have a pretty good quarter as well?
I did. I really did, because these are the two players, and maybe along with Amazon now, that really dominate digital advertising. Look at some of the smaller companies like Pinterest, who reported some disappointing numbers yesterday, and Snapchat and Twitter. They kind of play with the crumbs that are left by the Googles and the Facebooks and the Amazons here. So you saw some really strong numbers, really strong metrics out of Google, and Facebook experienced a similar type of marketplace.
So walk us through some of the other metrics, because I think one of the concerns is, I don't know, where should we go? Like first quarter daily active users, there's so many, headlines that come across the Bloomberg. Tell me what else you think our audience needs to know about, Paul.
I'll tell you what advertisers look at. They look at the size of the audience, and for Facebook, that's monthly active users, average users, that grew, and that was better than a forecast. And then the second question is, how engaged is that audience with your product? Because the more engaged they are, the more they are likely to be influenced by my advertisement. And for Facebook, that's daily active users. And the daily active users also came in very strong relative to expectations. So if I'm an ad salesman for Facebook, it's a pretty easy sell for me.
That's it. So I do think about kind of in this world, right? People are constantly trying to get our attention and sell us stuff. And I said earlier, when it comes to something like Facebook, Instagram, WhatsApp, I mean, they are very much aggressively looking to use those channels, right, to sell stuff. I know my 18-year-old, it's often how she shops. She's following influencers, and she's on Instagram, and she sees something, and then she finds out where, it's sold. Everything, has a tag on it. I mean, that they're looking to boost, right, in terms of their business.
Yeah, that's the one area that they'd really like to develop, and that's kind of the shopping aspect, shopping mechanism on Facebook. They've got such a big audience, it's such an engaged audience, and you're right, the influencers are such a big part of the retail landscape these days. You don't want to lose those people to as they close your app and open up the Amazon app. So you want to try to build that e-commerce business, and so they did launch a business called Shop about a year ago, but it really hasn't done that much. So I think that's going to be one of the areas on the conference call that investors are going to want to get some more clarity.
Okay, so is there anything in this quarter that bothers you at all?
Well, I mean, the comparisons are going to get tougher, which they kind of called out for the third and fourth quarter of this year. So you're not going to, and so they said kind of the revenue outlook in terms of growth rates is similar in the second quarter than what they saw in the first quarter, so that's good. Then the comparisons get tougher, and they said sequentially the growth rates will slow, so that's an issue. The other issue, which
will investors will they be hip to that? Do you think at that point? Because investors are like, okay.
Yeah, we'll see. That's why they're calling it out so early here.
Yeah.
If you didn't already know it, now you do. And so the other thing is Apple Computer is changing the way their apps target users. Right now, you opt out. You have to physically say opt out. I don't want you to track me, Facebook, when I go to other apps. Now, Apple's saying we're going to change that. Now you have to opt in to say yes, Facebook, yes, and all these other apps. I want you to follow me as I traverse all around the internet. Now, the question is that could be a real issue for digital advertising dollars if people start, failing to opt in. So we'll have to see how that plays out. We'll have to see how Facebook reacts. But typically, when those things kind of happen, and we saw something similar in Europe, what it does is actually benefits the incumbent players because advertisers feel like I'm just going to go where I know the audience is. So we'll have to see how that plays out.
Listen, Kurt Wagner, tech reporter here at Bloomberg News, says, boy,
Yeah,
Facebook is big. He is great. Is big these days. Head count as of the end of March was 60,654 employees, up 26% over a year ago. That's a lot of new employees to add during a pandemic, but it says something, I guess, they're busy and they're growing.
Yeah, and I've got two sons graduating from college in a matter of a week or so. So I'm like, call up Google. They're hiring. Go to Silicon Valley because those folks out there are hiring big time.
Well, it's funny that you say that. Ken Swig of Swig Equities was on with us, and he's a real estate investor and entrepreneur. And he said, look at who is tapping into real estate, like in New York. It's the Amazons, it's the Googles, it's the Facebook. They're not running to shut down offices or have everybody work from home. They're tapping into office space big time.
They are, and it's good to see, and it's good for the city of New York, and because it's prime real estate, and it's a lot of it, and we see it from all these companies, whether it's an Amazon or a Facebook or a Google. They are still so much in the investment mode. You look at their R&D, you look at their investments in property, plant, and equipment in terms of new real estate all around the country. They are still very much in the growth mode, still very much in the investment mode. So, and when they make this much cash, I guess it's easy to see why.
Yeah, it's interesting. And I was just passing something about, you mentioned earlier about Apple and having to opt in. And it looks like Facebook had made some comments about that. Here it is. Facebook listed ad targeting as a headwind, again, primarily because of changes to Apple iOS 14. But that was listed as a headwind last quarter as well. So, as an investor, the regulatory environment, Paul, we talk about this a lot. It does feel like these big tech companies are increasingly under the gun when it comes to lawmakers and policymakers. A lot of times it's just talk. I don't know. It feels a little different. What's on your radar when it comes to possible things that might be a drag on a company like Facebook going forward?
When I talk to tech investment bankers that I know, they say that Google and Facebook are really on the sidelines right now. It feels that way in terms of M&A because and sizable M&A because they know that they're being targeted by the regulators. So I think the risk is very low that they would ever be broken up, for example, but they know that the regulatory bar for making any kind of acquisitions is really high. And so they're just kind of staying on the sidelines, keeping their heads down, trying to stay out of the crosshairs, and then we'll see what happens going forward. But it is an issue, and we've talked about it a lot, that this, the U.S. regulators and even the folks in Congress, they've taken a very light hand really over the last 50 or 60 years towards U.S. technology and allowed Silicon Valley to grow and make all these great innovations. But that feels like it might be changing a little bit because you've got these mega companies like Amazon, like Google, like Apple, like Facebook that are just so pervasive across all of our lives. It's just not some industrial company or railroad company out in the Midwest. These are the companies that we touch every single day, and it goes to data privacy, data integrity. So there's a lot of issues and a lot of layers, and it's definitely a risk out there, I think, for a lot of tech investors in Silicon Valley.
Hey, listen, since I have you, because, we've been following, some of these big tech names, and we're waiting Apple. They should cross in about 8 minutes from now here. And just, it's a little bit of a mixed bag. Microsoft versus Google, what we're getting with Facebook. We'll see what we get with Apple. How do you see any consistent themes or anything as we go from report to report?
Well, it's interesting. I think for the software side of the technology space, it's really all about the cloud, and there's lots of applications for the cloud, and there's lots of different layers of it that the Anurag Ranas and the Mandeep Singhs of the world from Bloomberg Intelligence, they know really well. But what we do know is that cloud computing and all its applications is probably the biggest growth in tech spending, and that theme is still very strong, and it's a very competitive race between Amazon and Amazon Web Service, Microsoft with its Azure play, Google's in there as well, IBM has a play. So there's a lot of big competitors there, but it is growing very quickly, and the pandemic just accelerated that, again, as more and more companies were looking to put more and more of their data distributed on the cloud. So all of us working from home could have better, use of it, and we could use our applications on it. So big growth area there. And then the second area that we're seeing from these consumer technology companies like the Facebooks of the world is that advertising dollars continue to flow to these digital platforms. And again, the pandemic probably played a role as an accelerant there, as we're all spending more and more time on our devices here.
Right, and I would assume that we're going to continue. I mean, sure, we're going to go back out and we're going to travel and we're going to live, but we have gotten so much increasingly used to doing everything on our phone, right, and online that stuff doesn't go away.
No, it doesn't. And, another big area, because we're spending so much more time on our digital appliances, is security. And we hear that a lot from technology investors, is that is a great growth area within technology spend, which is security. The more time we spend, the more data we put up on the cloud or store in our devices, the security's got to be a lot better, because we know there are a lot of bad people out there with really looking to hack into a lot of these systems. So that's going to be another growth story as well.
I hear a lot of people who are saying, I keep getting messages, change my password. It's not complicated enough, or you've got security concerns. Paul Sweeney, love you. That was so great. Paul Sweeney, co-host of Bloomberg Surveillance and Bloomberg Markets. Catch him on Bloomberg Radio with Tom Keene from 9 to 10, and of course, Matt Miller from 10 to noon. Shares of Facebook, by the way, up 4.8%. We are awaiting Apple earnings. They're going to cross in any minute. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, top story at this hour, 3.3% higher. That's what we're seeing with Apple shares in the after hours following the company's latest earnings. And we are seeing some interesting numbers coming in, including Apple authorizing a boost of $90 billion to existing buyback program. Second quarter revenue, though, big beat, $89.6 billion versus an estimate of $77.3. Charlie, I'm going to let you take it away, but that stock on the rise in the after hours.
Up by just about 4% right now. The other big news, boosting its dividend as well. iPad revenue, $7.81 billion, estimates $5.65 billion. iPhone revenue, $47.94 billion, estimates $41.49 billion. Bottom line here, total revenue, $89.58 billion. Estimates on Apple, $77.30 billion. As Carol mentioned, authorized a boost of $90 billion to that existing buyback program and boosting the quarterly dividend to 22 cents a share from 20.5 cents a share. And again, checking Apple shares after hours, they are moving higher. Apple shares up now by just about 3.5%. Our coverage will continue of Apple. Not the only major tech reporting after the bell, but certainly grabbing a lot of headlines. We've got Facebook's first quarter sales up 48%, surging past analyst estimates, thanks to strong demand from retailers and other advertisers seeking to grab attention from the social network's billions of users. Qualcomm, world's largest smartphone chip maker, giving a bullish forecast for the current quarter, up by about 5%. On the minus side after hours, Ford lower after a disappointing forecast, down by about 3.5%. Does see a $2.5 billion cost from that semiconductor shortage. Fed news, Fed Wednesday, Federal Reserve giving a thumbs up on the economy, holding its benchmark interest rate near zero to sustain the COVID-19 recovery. And with more on that story, we've got this report from Bloomberg's Vinny Del Giudice.
Fed officials strengthened their assessment of the economy following today's policy meeting, signaling that risks stemming from the year-long pandemic have diminished. They're also attributing this year's inflation breakout to transitory factors tied to the recovery. At a news conference following the meeting, Fed Chair Jerome Powell added a few words of caution, noting the recovery is far from complete, with many Americans still out of work. Vinny Del Giudice, Bloomberg Radio.
And reaction from J.J. Kinahan, Chief Market Strategist at TD Ameritrade. He was our guest right here on Bloomberg Business Week.
I don't think they really told us anything we didn't already know. This is one of the few times, coming into the week, especially over the last few Fed meetings, where I thought the Fed might be the third most important story of the week behind all these big earnings, GDP.
And speaking of big earnings, Apple shares up now by 3.8%. We've got more on Apple coming up for you right here on Bloomberg Business Week. Down day, S&P tumbling 3 points, lower, little change, down less than 0.1%. The Dow down 164, down by about 0.5. NASDAQ down 39, a drop of 0.3. 10-year yield 1.60%. Gold up 0.3%, 17.82 the ounce. West Texas Intermediate crude keeping an eye on inflation. WTI up 1.2%, 63.69 a barrel on West Texas Intermediate crude. One more check on Apple. It is the big story after hours. Blowout report there. Apple shares up now by 3.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So definitely our top story right at this moment is Apple. Charlie breaking down the numbers, the quarter. The stock is up about 3.8% in the after hours. Big headlines, Apple authorizing an increase of $90 billion to its existing buyback program. Second quarter revenue, big beat, huge beat, $89.58 billion versus an estimate of $77.3 billion. And if you go through all of their product lines and business sectors, big beats in those as well. Let's get to it, though, on what you need to know about the quarter. From Bob O'Donnell, he's President and Chief Analyst at Technalysis Research. He's based in Foster City, California, and that's where we find him on this Wednesday. Bob, nice to have you here.
Thanks, Carol.
We've said it a lot, I feel like, today, but it looks like a blowout blockbuster quarter.
Yeah, absolutely. And, what's fascinating when you look through is there was a lot of focus on what services were going to do. And it looks like services did okay, but really the big stuff was good old iPhones and Macs. I mean, that's, those are the things that are really crushing it for them. And, from a regional perspective, again, obviously we're just going through this live here, but the China numbers are also looking really good, almost double from a year ago. So that's a clear sign of the fact that the iPhone 12 having 5G, that's what was critical for China, because 5G networks are very widely available in China, and without a 5G phone, Apple was at a real disadvantage. So the iPhone 12 selling through China clearly in big numbers, that's got to be a big portion of the reason there. And then Max, the M1, that's Apple's custom chip that they created based on ARM architectures. They've done this for the iPhone, but they introduced that last fall for the Mac, and clearly they had a lot of success with that. And of course, just last week, we saw them introduce M1-based iMacs and even brought the M1 to the iPad. So, we've got this custom silicon story that Apple's telling. We've got the 5G story that Apple's telling.
Right.
And look, the service businesses, all these other things are also doing well. It's not that they're not doing as well.
Right.
But it's kind of those traditional Apple businesses that the ones seem to be the standouts.
Hey, hang on for a second. Just got, it's been, talk about an overflow of Newsday, but it's all good stuff. Amazon just crossing the Bloomberg terminal to boost pay by at least 50 cents to $3 an hour to over 500,000 of its staff members, rolling out pay boosts from mid-May through early June to invest over $1 billion in incremental pay for certain staff. We probably will hear a little bit more about that tomorrow when the company reports its latest quarterly results. Amazon shares, let me just take a quick check here in the after hours, up about 0.8%. And just quickly want to mention Verizon exploring a sale of its media assets, including AOL and Yahoo. This is coming from Dow Jones. Could value Verizon media assets at $4 to $5 billion. So a lot going on. Quick check, though, of the stock here in the after hours. Shares of Verizon just down a hair, down about 0.1%. Any thoughts on Amazon or Verizon there, Bob?
Well, the interesting Amazon, they've caught a lot of grief lately in terms of their workplace standards and everything else. But another interesting data point just came out today is that Amazon was ranked as the #1 place to work by LinkedIn. LinkedIn did a huge study of the top 50 companies to work at in America, and Amazon came out #1.
Interesting.
Apple was also in the top 10. AT&T was in the top 10. IBM and Alphabet. Verizon was also, I believe, in the top 20, if I remember. But anyway, that I think is an interesting segment, and we'll see what happens with Amazon's earnings tomorrow.
Yeah, exactly. And I know we've been here at Bloomberg Business Week doing a lot of reporting about, and Bloomberg News, just Jeff Bezos thinking about his legacy, and what's to come. Yep. And so thinking a little bit more broadly about that. Bob, thank you so much. Really appreciate you breaking down Apple with us. Bob O'Donnell, President and Chief Analyst at Technalysis Research, on the phone from Foster City, California. Apple, once again, revenue, profit, topping estimates, iPhone, Mac, iPad sales, all exceeding expectations, and the company boosting its buyback program by $90 billion. Stock up about 3.4% in the after hours. All right, back to world and national news. Lots going on this Wednesday. Over to Nancy Lyons in D.C. Hey, Nance.
Hey, Carol. Well, fewer people will be in the audience due to the pandemic, but President Biden will be making his first speech to a joint meeting of Congress tonight. Bloomberg's Irv Chapman reports.
The president plans to outline his spending and taxing proposals from road repair to child care. Analyst Isaac Boltanski of Compass Point Research commented in a Bloomberg interview.
What we're going to get tonight is an incredibly ambitious and expansive proposal intended to remake our economy. But the reality is it's not going to happen. We're not going to get what the president calls for tonight, but we will get something of significance.
Boltanski said tax policy to narrow the gap between wealth and work will pass in some form. In Washington, Irv Chapman, Bloomberg Radio.
You can listen to full coverage of the speech right here on Bloomberg Radio beginning at 8:30 Wall Street time. Rudy Giuliani's lawyer says the federal raid of his apartment and office this morning amounts to legal thuggery. In a statement, Robert Costello says the searches were unnecessary because Giuliani offered to answer questions from prosecutors, except those about his privileged communications with former President Trump. Investigators seized Giuliani's electronic devices after serving a federal warrant. A new poll shows Americans believe COVID-19 is no longer the most pressing issue facing the country. According to Gallup, 1 in 5 Americans said COVID is the most important problem. That's down by 25% since March. This is one of the first times that Americans have been less concerned about the virus since the pandemic began. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. Carol Masser here in our Interactive Brokers studio on what has been a busy day. Fed meeting, of course. We broke that down, and we've been breaking down a bunch of earnings. Charlie Pellet joining me at Bloomberg News, and really two of the big ones, no doubt about it, is Apple and Facebook, Charlie. Apple revenue, profit, topping estimates, iPhone, Mac, iPad sales, all exceeding expectations, and a big deal, and we've been seeing this with some of the big tech companies who have so much money, they generate so much cash. Company boosting its buyback program by $90 billion, also raising its dividend, and that is enough to make the stock move higher. I got to say, Apple investors, they've had a pretty good April, but for the year overall, the stock was kind of like a little move, maybe
Indeed.
up about 1%. So
yeah, up by about 0.7% for the year to date on Apple.
yeah, so investors were looking for a catalyst. They definitely got it today.
Yeah, exactly. Very interesting, though, to see how this will play out with the Asian markets tonight. Apple, Facebook, and of course, how, if at all, this is going to affect technology, going to affect sentiment tomorrow. Obviously, a lot can happen between now and 9:30 a.m. Wall Street time tomorrow. But again, worth repeating, Apple reporting quarterly revenue absolutely crushed expectations, fueled by sales of 5G iPhone 12, the iPhone 12 line, and purchases of iPads, iMacs as people continue to work and learn from home. As has been its practice for the past several quarters, Apple did not provide a forecast.
No, it did not, but investors don't seem to care. And Facebook also out with its earnings. That stock up about 5.5%. This is going to give a big boost, certainly to the trade potentially tomorrow, especially when you look at the tech sector, which we saw under pressure in today's session. Facebook first quarter earnings sees tougher sales comparisons, though, in late 2021. That makes sense as we came out of the pandemic. Headcount, though, surging 26% in the pandemic. They were on a hiring spree. Company managing to eke out new users in North America. And again, investors, Charlie, liking what they had. And then there was Amazon just coming out with a headline. We're going to be talking about their earnings tomorrow, but boosting pay by at least 50 cents to $3 an hour.
All right, I'll raise you one. And of course, we had the headline from Verizon. They're exploring the sale of AOL and also Yahoo.
I'm exhausted. Yahoo. All right, Charlie, thanks.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Apple sales crushed Wall Street estimates on surging device demand. Apple shares up now by more than 3%. It is also boosting its dividend and boosting buybacks by $90 billion. Facebook sales and users jumped as gains during the pandemic persist. Facebook after hours up by about 5.5%. Ford's profit beat was overshadowed by a cut in its full-year outlook. Ford shares down by 3%. Amazon will be boosting pay by at least 50 cents to $3 an hour to over 500,000 of its staff. And Verizon said to be exploring the sale of media assets, including AOL and Yahoo. That, according to Dow Jones. Verizon shares after hours, they are trading now little change. Lots going on. Stay with Bloomberg for the very latest. Today, we saw the Dow, the S&P, NASDAQ all declining today. A Fed Wednesday. Equities slipped with the S&P down 3, a drop of just about 0.1%. The Dow down 164, down 0.5%. NASDAQ lower by 39, a drop of 0.3%. 10-year yield 1.60%. Gold up 0.3%, 17.81 the ounce. West Texas Intermediate crude up 1.1% at 63.66 a barrel, and gold higher by 0.3%, 17.81 the ounce. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, great update. Charlie, thank you so much. So we are focusing on a lot today. Of course, Fed policy, tech earnings, and over the past 13 months, we focused a lot on health. And we know the pandemic has impacted our physical and mental health. Safe to say we're looking at healthcare in a much more holistic way. And for members of our world who have had underlying healthcare and medical conditions, the pandemic may have been tougher or a very different experience. And with that in mind, we welcome Charlie Massimo. He's Senior Vice President and Financial Advisor at Wealth Enhancement Group. He's also founder of Autism Communities. He's father of 2 teenage sons who have autism, and he joins us on the phone in Long Island. Charlie, it's good to have you here on Bloomberg Radio. How are you? And tell us about your past year and what it's been like.
Well, thanks so much for having us, Carol.
Sure.
For having me. Yeah, it's been, as you said, it's been real difficult, especially having children with autism. I think all families that have had children with autism, the restrictions to see them, have been real difficult over the past few years. I only saw my 2 boys probably 3 times over the past year.
Wow.
And that's really severely impacted them, and it's impacting families, across the entire country.
Did they understand why you couldn't see them?
No, unfortunately, it's a great question, but as much coaching as their therapists try and do, they don't really understand or comprehend why they can't see mom, why they can't see dad, why they can't see their sister, why they can't come home. It's been really difficult for them.
I do think about this a lot in general for people who are autistic. I think about kids in general. I passed a house where a kid had signs up and said, please open the schools. I have no friends. I'm tired of Zoom classes. I think about the impact on kids in general and just people who have underlying conditions that, what this year has meant to them and the setback. Tell me a little bit more about that and the times that you've had with your sons. Is anything opening up too? I'm curious.
Yeah, it is. Housing has always been an issue with autism. When you think about the impact, there's over 7 million people, adults at least, with autism or some form of autism. And, the numbers are staggering. Every 10 minutes, a child with autism becomes an adult with autism. Those transitions are incredibly difficult for them. And those transitions this year, with a lack of stability, with the lack of supports, has been devastating to them, and probably most of them have regressed to a point where probably the past few years of therapy has been almost erased.
What is it about our system? Because to be fair, I feel like nobody had the playbook for dealing with this, right? We just who would have thought, right, the United States of America would be dealing with a health pandemic, but here we were. And, we've kind of tried to figure a way, and I feel like healthcare in particular, the medical community, even just like I said in the introduction, we are thinking much more about mental well-being than we ever were before. And I think most people, fingers crossed, hope that stays with us on the other side of the pandemic because it's a real thing. But we need to kind of look at all pockets of our society because of things like this that really can have a major impact.
Carol, I couldn't agree more. Our focus at Autism Community is really to address the housing need. And when you think about it, housing is necessary for stability in all of our lives. And every person, regardless of disability, should have access to housing and support services where they really need to thrive. Yet, again, this year, you think about there's over 6 million adults with autism that don't receive any publicly funded residential supports. So when you think of the impact that has on our entire system, on our economy, the drag that it's going to have on the mental well-being of these families, not just the children or the adults themselves, but think of everyone that touches them that has been impacted by this. It's millions and millions of people.
Well, tell me about what typically happens when a child with autism becomes an adult with autism and what happens. I'm sure we've all seen different news segments and things, but you are in it and understand it. What happens when it comes to housing? Where do autistic adults go?
Yeah, it's a question that we are trying to solve that answer to. And again, it's not just here in New York, it's countrywide. And like I said, there's over 6 million people that really get no residential supports. And the reality is the vast majority of adults with autism live with their parents or caregivers until those caregivers die. So think about the support system that they lose when that happens. So and even if you go into a group home or want to go into a group home, the waiting list is upwards around 10 years. So at Autism Communities, we're trying to address this severe lack of affordable and safe housing by providing alternative housing solutions so that they don't have to wait till their caregiver is no longer here or can't do it, that they can start to go out into the community and build a community for themselves that will last for as long as possible. But it's a major, major issue, and many are trying to address it right now.
And homeless rates have been rising, correct, among autistic adults?
It's skyrocketing, and especially those that are higher functioning. When you see a person with, forgive me for saying, classical autism symptoms or indications, you can know, you see that right away. But for those that are higher functioning on the spectrum, those that just socially don't have the ability to have this conversation today like you and I are, that's where the homelessness rate is rising significantly, because to you and I, they look like normal men and women, but they just can't function the way you and I function in this world. And again, that's a severe problem.
Charlie, so just got about a minute left here. What would be your advice? I feel like it's very timely. We have a president who is thinking about the future of this country, looking to make investments, to also provide assistance to people who need a leg up and have been kind of forgotten in some of the economic recoveries that we've seen over the past decade. So what would be your advice in terms of policy? And again, just got about 45, 50 seconds here.
Yeah, I think there has to be some policy made that those that are developing units out there throughout the country are giving more incentives to develop units and to develop affordable housing for those on the spectrum and reward them somehow, provide more grants, provide more money to provide this affordable housing that's just not there right now. It's a segment that is totally lost in policymakers' eyes.
Well, I wish you well, and we've got a smart audience and people who can get things done, so hopefully some of them will take your words and turn it into action. We wish you well, Charlie, and hopefully we can check back with you again. Charlie Massimo, he's Senior Vice President, Financial Advisor at Wealth Enhancement Group, and he's founder of Autism Communities, joining us on the phone from Long Island. Folks, I don't know about you, but I could use a drink because it's been exhausting. A lot of news, Fed news. We got pretty much what we expected from the Fed. Markets kind of taking it in stride, but talk about some big moves in stocks. Facebook definitely on the move. So too is Apple. There are going to be stories that we're going to carry over into the Thursday trade. For the whole Bloomberg Business Week team, have a great evening. I'm Carol Masser.